of the online comprehensive course on valuation and valuation standards for the members of the Institute of Chartered Accountants of Nepal. I am CA Shruti Gupta, moderator for today's session. So without any delay, we will start with the first part of our session, for which I would like to invite CA Ankit Goyalji. CA Ankit Goyal is the founder partner of AAA Valuation Professionals LLP, one of the first few registered valuer entities registered with IBBI for all three asset classes, and one of the largest with 25 partners and 20 cities across India. Apart from being a registered valuer for SFA, Ankit Goyalji is also a practicing chartered accountant and insolvency professional and holds a graduate degree in law. He actively speaks on valuation, insolvency, and forensic audit related topics at various forums, including events organized by various registered valuer organizations, insolvency professional agencies, Institute of Chartered Accountants of India, ASSOCHAM, SBI, Gurukul, etc. AAA Valuation Professionals LLP has, during its short span of 5 years of existence, completed valuation of assets of more than rupees 50,000 crores and was recently awarded with the award for most number of valuations done by a registered valuer entity registered with IOB RVF in 2022. We look forward to learn from you, sir. Thank you so much for gracing us with your presence. Over to you, sir.
Thank you so much, Shruti, and thank you to ICAI Valuation Standard Board for taking this initiative. A 5-day program is a massive program to organize, and kudos to the organization team at Valuation Standard Board to take this forward. To all my friends in Nepal who are listening to me, I believe that I have interacted immensely with valuers from Nepal, and I understand how the valuations work in Nepal, where yes, a lot of land and building valuations are required from the state bank and I understand that they have some guidances to empanel valuers. With respect to securities of financial asset valuers, I could understand that these regulatory valuations are less, and it will be more about the consultative valuations that will happen. So if I'm wrong there, I will request the participants to bring that knowledge to me. It will be enlightenment for me to understand if there are any regulatory valuations required in Nepal for businesses and intangible assets, which is my topic, so that I can begin perhaps closer to what is the objective of applying these standards to those valuation requirements. Because whenever we talk about standards, whenever we talk about valuation standards, we always talk about the applicability and how these standards need to be adopted as per the local laws, and how then these standards become more relevant and they are usable. I would also like to say that the standards that we will be talking about, ICA valuation standards, were published in 2018. They are pretty comprehensive with respect to what all approaches one can follow, what all methods one can follow, what premises one can take up, what can be so these are all parts of trying to find out the right valuation. And when it comes to a business or when it comes to intangible assets, these factors become immensely important. So I will quickly brief on these approaches and these methods and so on, so that we are all on the same page when I talk about these specific words or terminologies. So when we talk about approach, we are always talking about 3 possible approaches, which is the market approach, income approach, or cost approach, or asset approach. It is very important to discuss these approaches because in different methodologies, in different parts of how we value assets, we will use different approaches. And in most of the cases, when it comes to business interests or when it comes to intangible assets, we will be relying mostly on income approaches and market approach. Cost approach will be seldomly used, only in exceptional circumstances. And when it comes to income approach, what is the economic principle that we are implying? We are talking about anticipation of benefits as the economic principle. So to give an example, if I'm wanting to invest in a business, and I say, somebody tells me, what will you pay for it? My answer can be dependent on what will be the future cash flows from that business once I buy it, and how can that value be, or what will that value be today, based on my understanding of the future cash flows that I can derive from that business or the business can come out with. Similarly, when we talk about market approach, the economic principle that we are following is the principle of price equilibrium. What is the principle of price equilibrium? That a market, whenever it behaves like a market, has a price equilibrium. So in case I go out and say my business is having 100 crores of turnover, I want 1 lakh crore for that business. What will happen? I will not find any buyers and I will reduce my asking. And that is what is the economic principle behaving here? It is the economic principle of price equilibrium. That in the long run, the market, the buyers and the sellers will come at a price, or arrive at a price which is mutually agreeable. That is how our stock markets also function, where buy side, sell side keep asking and keep bidding for different prices, and eventually a transaction happens only if the buyer or the seller, or buyer and the seller, come at the same price. So that is what is price equilibrium. So when we talk about price equilibrium as a method for valuation, we are inherently relying on the fact that we will find some transaction in the market. It can be a publicly listed share, it can be a closely held company where an external investment has come in, but these transactions can be taken as a comparative for the purpose of finding the value of my business. So in case I say that I have a business in manufacturing of, let's say, cars, and yes, I know that somebody, Maruti Suzuki share, let's say, is trading in the market at this much price, and they have, they manufacture these many cars a year, or they have this kind of EBITDA or turnover in the year, then I can accordingly try and value my business looking at that transaction in case my business is equitable or similar to that business, right? So this is how this market approach works. And when it comes to cost approach, the economic principle is the value, or the economic principle of substitution. That in case I want to recreate this, then what will I spend? What will the cost be if I want to spend it? And that is something which is difficult to anticipate in case of intangible assets, in case of businesses, because there's a lot that goes into that business, and normally therefore income and market approach become preferred approaches. Now coming to uh, this is approaches. Now coming to methods. When it comes to methods, the typical methods that we find everywhere is, as I said, publicly traded comparable method, transaction comparable method in case of market approach. And in case of income approach, we find DCF. And in case of intangible assets, we will have many other methods that we will just talk about. Now, when it comes to this is market valuation approaches, valuation methods. Then we come to valuation basis. Valuation basis can be what kind of valuation basis are there? There can be market value, there can be liquidation value, synergistic value, there can be equitable value. So these are what kind of value do you want? Do you want the value which will be available in the market, or which the market will find out? Do you want the value that these two specific buyers and sellers will likely be entering into a transaction at? So that is a equitable value. Then it can be investment value. That do you want a value with respect to what kind of value is the investor deriving from this investment? It can be then liquidation value, that what kind of value can you derive if the entire entity is liquidated. So these are basis of value which we talk about. Then we talk about premise of value. What is the premise of value? It is more of an assumption with respect to what basis, or what is the primary assumption with respect to your valuation. So there, what are the options? There can be highest and best use. There can be actual use that is happening right now. There can be, in case of liquidation, orderly liquidation, or forced sale liquidation. So these are the premises. So once we have these four figured out, then we can try and find out what is the best method based on the information available. And the information available can be different for every valuation assignment. It need not be the same for any two valuations at all, because different information can come up or can be available to you for different assets. So I will share what I intend to do is, I do have a PPT, but what I thought will be helpful is that I read this about, or I talk about things while having the standards in front of you. So the ICA valuation standards are very much available publicly on ICA's website, and I hope all of you can get hands on it. And what these standards, reading the standards can give you a outlook into, of course, how to make your valuation reports better, how to incorporate methods and things that will make your valuation report more robust. It will also almost teach you with respect to certain valuation methods that how is that valuation method supposed to be implemented. So the methodology and the steps with respect to certain valuation methods is also talked about very, very rigorously in these standards. And in case you're following these standards, then you can very well take care of that as well. So I will move on. So this is business valuation. When we value a business, what are we looking at effectively? As I said, income approach, market approach will be the primary methods, but we are trying to value a business where the business is a going concern. The balance sheet or the financial statements of the company will only show those assets which have been paid for by the company or fair valued by the company in case of Ind AS or other such implementation. So what are we looking at? We're looking at a balance sheet or a financial statements which lists out all the financial assets and all the tangible assets that the company owns. It can be inventory, it can be fixed assets, it can be plant and machinery, land and building, it can be office equipments, it can be sundry debtors, it can be loans and advances. So these will be listed in the balance sheet. But if I total this and I total and say that okay, my total asset value in my balance sheet is this much, can this be the value of my business? I think most of you will say, no, this should not be the value of the business that I would like to consider as the business value of this business. So what are the assets or what are the parts in the in this company or in this entity or in this business which are not recorded in the financial statements which I want to value? If anyone has an answer there, I will love to hear from you. But the point is that yes, the hidden parts are the self-created intangible assets and the goodwill. Now, self-created intangible assets, what can they be? They can be they can be assembled workforce. It can be other intangible assets that allow the company to make more money than maybe other companies, where you can have customer related intangibles, you can have a contract which gives you certain benefits to trade in the market. So it can be a lot of things which we will discuss further. So these are one intangibles that get added and that need to be estimated through the business valuation that we're doing. Also, there can be goodwill. What is the goodwill? Goodwill can easily be defined as that intangible asset, which is simply the future earnings or present value of future earnings that can come to the business due to all these assets working together. So that is called goodwill, which is the hidden asset in the business. Because in case you look at listed companies, now listed companies will have an X book value and maybe the shares will be traded or rather the market cap of the company will be 10x. What is this 9x difference? 9x is basically the one part of 9x is the intangible assets that are not part of the financial statements. Other part of this 9x, which is the remaining value between or difference between the book value and the listed or the market capitalization, is the goodwill or rather the value of future earnings, which is valued for today. So this is or the value of growth in the future. This is what you can say with respect to that differential value with respect to this 9x difference, right? So this is how it works. So today we are trying to value the business value, or we are trying to value a business and trying to understand what are the methods that we can try and use to value that business. So what are the possible reasons why you will do the valuation of a business or an ownership interest? You might want to do an acquisition or a merger or a leveraged buyout, initial public offerings, ESOPs, and so on. There can be a dispute that you want to resolve for which you want to do this. There can be financial reporting, there can be tax matters, there can be valuation for planning, internal use by the owners, valuation under IBC. So all these are possibilities where the valuation requirement can come in for a business per se. Now, the uh, principles that we are talking about in this standard have to be read with all the other principles that have been brought about in the valuation standards. You don't, kind of use this in isolation. But yes, the principles stated in this valuation or in this standard are specifically required to be applied in case you're valuing a business interest or a going concern entity. So there, that becomes then mandatory to be taken care of. So then, of course, this 8 number, the para 8 talks about how the valuation standards are not mandatory to the extent where the standards talk about something which is not consistent with the law. So in case you have any regulatory law or a regulatory provision where you want to, where there is a provision, let's say in the Indian Income Tax Act, there is a provision that, let's say, the valuation for shares or transfer of shares has to be done using, sorry, valuation of shares for fresh issue of shares has to be done using, let's say, DCF by certain companies. So in that case, a discounted cash flow method will be the only method that I need to use, even if the market approach or say some other standard might be a more might be a better standard to follow. So that is something that automatically comes up then. Then significant elements, a business valuation is the act or process of determining the value of a business enterprise or ownership interest therein. So this is, of course, we understand that. When we talk about the various values, so we talk about enterprise value. How do we define enterprise value? We say enterprise value is the value attributable to the equity shareholders plus the value of debt and debt-like items, minority interest, preference shares, less the amount of non-operating cash and cash equivalents. We also then have business value. Business value is the value of the business attributable to all shareholders. Then equity value is the business attributable to equity shareholders. So how do we differentiate this? So enterprise value is the value of the business. So irrespective of the debt, let's say a business is having a company has a business, and that business is funded by the loans from banks as well as equity interest. So in case of enterprise value, we will take out the value for the entire business and we will not subtract the debt from that asset value. We will simply say that the enterprise value is 100 rupees in case the enterprise value is 100. And let's say the debt is 40 and the equity is 60. So for equity value, it will come to 60. For business value, we will say that it is the business value of the business attributed to all shareholders. So here again, we talk about preference shares, we talk about other convertible shares. So we give the value based on that business value. So when it comes to valuation methodology, we define the premise of value. As I said, what can be the premise of value? It can be highest and best use. It can be existing use. It can be in the case of liquidation, it can be forced sale or orderly liquidation and so on. Then we talk about analyzing the asset to be valued and collect necessary information. So when we talk about a business interest, we of course want to collect all the industry data. We want to collect all the historical data with respect to that business which is available. We need to understand what are the budgets and future expansion plans of this business. We want to take projections for future. We want to make sure that we have the details with respect to what services this business supplies, what price segment this business is into, what kind of competitors or who are the competitors of this business within the same market, so that we can try and find some comparables from those assets or those businesses. So these are the kind of values or these kind of details are collected. Then identify the adjustments to the financial and non-financial information for the valuation. So we understand that what kind of adjustments are required. So what can be the grounds of various adjustments when you're comparing, some other transaction with our transaction? So the adjustments in case of income approach can be that, okay, you have financial data up to the last year, but that financial data has certain items or certain extraordinary items which will not be repeated in future. So you will try and remove those or give an effect that, effect to the valuation, which effectively removes that effect on the valuation or on the cash flows. Then similarly, what you will do with respect to non-financial information, you will try to understand what kind of quality of the products, what kind of market is it, what kind of market reach does these projects have, what is the geographical region in which this company operates, to understand that how would you want to compare this company with maybe some other company in the industry. Then you consider and apply appropriate valuation approaches and methods. You've already talked about that extensively. Then you arrive at the value or a range of values. You identify the subsequent events. And then you also kind of, with respect to the premise of value, it refers to the condition and circumstances, how the asset is deployed. And the premises shall always reflect the facts and circumstances of each engagement, and it depends on what is likely to happen to the business as contemplated at the valuation date. So in case you say that, okay, the business is going to expand, there is an expansion plan in the corner and that is already approved, that is already being implemented. So maybe you will say highest and best use, and you will say, no, I don't want to value the existing business alone. I also want to value what will be the business growth, what will be the effect on the business value in case this capex comes in on this, or or this additional investment comes in, and what kind of revenues will it grow the company to. So you would want to consider that growth within the valuation. In case you say, okay, I don't want to do, I don't want to add that expansion. I only want to, consider the existing business. In that case, you will give the case of the existing business only, or the existing unit only. So this way the premise, but 90% cases, the premise will be highest and best use. Existing use will be only in the minority cases where, there is certain assumption required in the valuation requirement, where you feel that, no, I did not value the expansion. I should only value what is going on already. An example to that is, let's say there is a shareholder dispute. Now the shareholders are disputing that, okay, we want to separate, and they ask you to value the business. So in that case, if one shareholder has expansion plans with respect to the business, and he can make things better for the business, we would maybe, give it a passing, and we would only value the business to the extent of what is already being, carried on, what is already implemented, and not take care, or not bring in the expansion into the whole picture. So analysis of asset to be valued. So the analysis of asset to be valued shall assist the valuer in considering, evaluating, and applying the various valuation approaches and methods. Nature and extent of information required to perform the analysis shall depend upon nature of the asset to be valued, scope and purpose of the evaluation engagement, valuation date, intended use of the valuation, the applicable ICA standard, the applicable premise of value, and so on, assumptions and limiting conditions, applicable government regulations or regulations prescribed by other regulators or other professional standards. So let's say you're valuing a startup which has just started, it's only 3 months old. And the person who is running that startup is, let's say, a very, very famous personality who has already kind of done very well in the previous ventures. And there are people who want to invest in that business. Now, do you think it will be possible for somebody or some investor to come in and say that, okay, I will buy a minority share of, let's say, 20-30% in the company. I will give you all the money that is required to start the business. And you, for the remaining shareholder, you will remain the remaining shareholder, and we will, keep expanding the business as time passes. So in this case, how do we value the business? What is the nature of asset to be valued? Because there is no business as on date, the business is yet to start up. So how do you value the asset, or nature of the asset which is to be valued? So the nature of the asset in this case can be the business that will start, and the business that will take shape. So there might be a business plan with respect to how many units this company will open, how will it expand, what will be the price per unit, what will be the kind of profitability that comes out of these units. So the nature of assets can be, which are required to be valued, can come out of that. Scope and purpose of the valuation engagement. If you know that the scope and purpose of the valuation engagement is to give a fair value of the shares so that the issue can happen, or share issue can happen, then you maybe state that, and that will also comply with how we kind of manage this process. Then the valuation date, the intended use of the valuation. So all these things can slowly start taking shape, and you can record these in your valuation report, and these might or might not affect your valuation. Now, in case you say assumptions and limiting conditions, so in this kind of an example where I was talking about, the limiting condition will obviously be the fact that there is no historical number, or historical financial, or historical performance that we can rely on, and therefore that will be a limiting condition. But there is no option on that front. We can't really work on that and kind of do anything with respect to that. With respect to the analysis, in analyzing the asset to be valued, the valuer shall gather, analyze, and adjust the relevant information necessary to perform a valuation, appropriate to nature or type of the engagement. Such information shall include non-financial information, ownership details, financial information, and general information. So this is how it works. Now, the detailed guidance in this respect, of course, they have given in the scope of work analysis and evaluation. So, non-financial information, I've already given you some examples that what kind of management quality non-financial information can be, what kind of geographical region is it, So all that information can help you. Ownership details can help in the sense that if ownership details is fractured ownership, then of course something can change. If the ownership is majorly with someone, then that can change things. So ownership details kind of sometimes can affect the valuation. Financial information and general information. Now, financial information with respect to historical financials can come to you. Financial information can also be what kind of monthly performance is coming out of the MISs that are made. And of course, general information is something where we talk about the industry, we talk about what kind of growth is happening in the industry, and so on. So a sequence is not important. You can always get various data at various points of the valuation that is being done. Then, of course, conditions, rights, and obligations of ownership right is talked about. So ownership right can have different rights with respect to liquidation, with respect to certain rights, with respect to board seats, rights with respect to, certain clauses like where you can say that these are restrictive clauses where some investor says that without me, you can't really issue new shares, you can't really, without my consent, change the board, have a board meeting, and so on. So those are restrictive clauses which give additional rights to certain people. So that is something that, of course, is important to be considered. Partnership agreements in such kind of businesses can have an implication on the values again. So there again, this can come up. The type, availability, and significance of such information may vary. So yeah, as I said, different businesses or different information availability can actually affect the information or affect the valuation in different ways. Certain information can be very, very crucial. Some information can maybe is not that crucial. So in case, let's say you have a litigation and a litigation that is affecting the business, and the litigation is something which is running into crores of rupees. Now, somebody can say, though, this does not affect my business. Somebody can say this affects my business because it's a very, very strong liability, and anyone who will invest in this business or trade in that business will have to give the effect of that value. Now, in either of the cases, what happens is that it becomes important for us to understand that uh, there can be again, a difference in judgment with respect to how that litigation might affect the value of the business. Somebody can say, "Oh, this litigation will for sure be resolved, and the company will have nothing. Nothing will be required to be paid by the company on account of this litigation." Somebody can say, nah, no, there is a strong possibility that this will convert into a liability. So in those cases, we can rely on experts. We can look into the documentation that is happening and the track record that is there, and based on other factors, we can either consider or not consider those values or those effects of those values or effects of those items. Adjustment to information from financial statements. So we talk about adjustment from historical financials. I was talking about how the historical financials are adjusted on account of non-recurring nature items, and how the cash flows and the future cash flows are estimated from the historical financials. So financial statements are adjusted to be analyzed, include those of the underlying company and other entities. So you look at financials of the target company. You also look uh, at the financial statements of other comparable entities and make adjustments wherever they're required. For an example, I can say that let's say a company sold a land and building. Now, the profit from that land and building is not something that is going to be recurring. So you remove that profit, whether it is the target company or the comparable companies, and try to kind of merge those companies and try to make them more, try to make them comparable to each other or similar to each other for the purpose of comparison. Now, adjustments to financial informations are modifications to reported financial information which is relevant and significant to the valuation process. Adjustments may be appropriate for the following reasons, amongst others: to present financial data of the underlying and comparable companies on a consistent basis, to adjust revenues and expenses to levels that are reasonably representative of continuing operations, to adjust for non-operating, non-recurring assets and liabilities and any revenues and expenses relating to non-operating items. So what are we talking about first? We talked about present financial data of the underlying and comparable companies on a consistent basis. So you want to financial data for a consistent. You don't want a haywire data that, oh, this year we had bad debts of 100 crores, so we wrote off those bad debts, so the losses are high. This year we recovered bad debts of 50 crores, and therefore the profit was high. So you will like to normally adjust all these impacts and all these things, and then you kind of put them on a comparable footing. You adjust revenues and expenses to levels that are reasonably representative of continuing operations. So you don't want revenue coming in from uh, maybe a rented property, revenue coming in from write back of creditors. So you don't want all those revenues to disturb your valuation or rather disturb your cash flow trends. So you would want to adjust that. Non-operating, non-recurring assets and liabilities and any revenues and expenses relating to non-operating items. I think rental is something that I talked about, that if you have investments, then you want to remove that. You have dividends coming in from certain investments that you own. You might want to consider the value of those investments separately as a non-operating item, and then also remove the effect of income from your balance sheet. So those are things that kind of impact the cash flows that you are making for the purpose of doing this value. We've already talked about market approach, income approach, and cost approach. And those are, of course, parts that are available for businesses as well. Market approach, what are we doing? We're looking at market price method, we're looking at comparable companies multiple method, comparable transaction multiple method. We're also looking at, of course, we're talking about identifiable and identical and comparable assets, liabilities, or a group of assets and liabilities, such as a business. With respect to income approach, we talked about how the income approach is mostly DCF, where you kind of try to anticipate cash flows, and then you bring them to a single current amount after discounting them, and you kind of come at a current market expectations about those future amounts, you arrive at that value. Cost approach, again, something where you value the value based on replacement cost method or a reproduction cost method. In liquidation, it is basically important to understand if the value will be realized on a of an asset or a group of assets when an actual or hypothetical termination of business is contemplated. So here liquidation is talking about the termination of business and what kind of value will be derived from the business after it is terminated. So that's where the liquidation value comes into place. Rule of thumb or benchmark value. So rule of thumb or benchmark indicator is used as a reasonable check against values determined by the use of other valuation approaches and evaluation engagement. What is a rule of thumb example? Let me give you an example. So say for a thermal power plant, if somebody says, okay, value a thermal power plant. So the rule of thumb mostly is that, okay, it is mostly 5 crores or rather 3 to 5 crores per megawatt. So that is the kind of thumb rule valuation. Similarly, in case we talk about businesses, we can say that, oh, the value of business can be 5 to 10 times of the EBITDA depending on the industry. So this is a rule of thumb or a benchmark kind of a value, which kind of, travels in the market where, people make these kind of benchmarks based on their experience and based on the kind of markets, based on the functionality of the market. So what does the 5 year of profit mean? That in case you're selling your business today, you're trying to encash next 5 years of profit while you're selling that business, and then whatever that person is able to make more, or maybe he's able to add further value into the profits, that's his. But today, in case you're making, let's say, 10 crores a year, then your value can be 50 crores or 100 crores depending on what industry you're sitting, because you're asking for 5 years of profit or 10 years of profit. So this is how it kind of a benchmark or a rule of thumb works. I'm giving you some examples. So any other example of rule of thumb or benchmark value that you can think of that you would want me to talk about, please put it on the chat box and I will be able to have a look at that as well. Or we will be able to talk about that as well. So this is how the kind of values happen. Then, of course, we talk about treatment of non-operating assets and intercompany investments. So in case of operating assets, entity holds where non-operating assets are held. So these are kind of valued separately, and these are then added to the operating assets. Similarly, in case of intercompany investments, you would talk about intercompany adjustments or substantial cross-holding between the companies, and you would want to set off those cross-holdings in a particular way. Consideration of capital structure of business. So business is usually financed by a combination of investments such as equity interest, debt, quasi capital, and so on. So basically, when it comes to all these parts, consideration of capital structure, how does it affect the value of the business, the capital structure? So it affects the value of the business, or maybe it doesn't affect the value of the enterprise per se, or mostly, but it can definitely affect the value of certain investments held. So in case I am having an equity share in a company versus somebody who is having a preference share in the company, the value can be very different. I might say that, okay, I have the right to participate in the voting share, I have the right to sell this share in the market and whatever, and therefore the value is X. Now, a preference shareholder can say, oh, I only have 6% or a 10% dividend that I get every year, and I will get redeemed after 20 years. So, can the value of equity shares be also be denominated or given to the preference shares? No. Similarly, there can be different approaches where there can be convertible preference shares, where the convertible preference shares are having a priority with respect to the liquidation value. So in those cases, we use option pricing models, we use Black-Scholes and other models to kind of try and find out that what is the value of that option that is available with this person with respect to early liquidation, and we then denote that value or add that value in the valuation that we're doing for that security, and effectively also subtracted from the other assets or other investments, or sorry, other instruments like equity, etc., where the effect will not be there, or will the effect be the contradictory effect, where somebody has liquidation preference, so equity shares will have a lesser liquidation preference. So similarly, there can be dividends, there can be other cases or other issues where similar structures can affect the value of those instruments. The value is an estimate of a business or business ownership interest arrived at in applying the valuation procedures appropriate for valuation engagement and using professional judgment. So this is the value definition of value, and I think when we are looking at the value, we are looking at assessing the reliability of the result, selection and reliance on appropriate methods. I think we've already talked about all that, and informed judgment and all that is also there. Applicable premise, we're looking at intended use of the valuation, we are using at non-operating or excess assets, how to take care of that. So effective date is then again prescribed. So this is how the standard with respect to business interest takes care of all these things. So I can maybe ask the team at ICA Valuation Standards to maybe allow for some questions at this stage where we have completed the business and business interest valuations. In case there are any questions, any comments from any of the participants, we can take it up right now, and maybe we can discuss those queries and those questions before we move on to the intangible assets part. This will also help me understand if there is any specific part within these standards that needs to be talked about. Now, when we talk about actual valuation approach or valuation model that we can use a DCF, we can use a comparable company method or a comparable transaction method, as we talked about here. And then, of course, we normally make a valuation model which kind of gives us those values. In a DCF, you will normally compute FCFF, free cash flows to the firm, and then you can compute free cash flows to equity or free cash flows to firm, and then you can, of course, project that for 5 years, 10 years, or maybe more years, depending on what kind of growth are you looking at in the next few years. And then after that, once these earnings normalize, you kind of take out a terminal value with respect to those values, and then you discount these cash flows based on a discount rate. Discount rate is normally taken from the market with respect to what kind of return would the market normally seek with respect to that instrument, with respect to that security, based on the expected market return, or what the market is expecting with respect to similar securities in the market. That is how it would normally it would work. And similarly, market comparable method or transaction comparable method, you talk about, what kind of qualitative and quantitative parameters do you want to match the two valuations at, and then what kind of differences are there, and how do you adjust those values. So this is how you would normally take care of those differences. So coming to intangible assets now. So intangible assets, as I said earlier, are those assets which might be self-created, which are very much part of the assets owned by an entity. It might be they might be part of the balance sheet or showing up in the balance sheet if somebody has acquired them from third parties. They may not be available at all in the balance sheet, or they may be, hidden totally in the assets of the company in case the values have increased subsequent to what they were purchased at, or they were self-created. So this is how intangible assets are part of a financial statement. So the objective is, of course, here to talk about intangible assets and specific guidelines with respect to valuation of intangible assets. What are the opportunities, or what are the places where intangible assets are required to be valued? There can be a purchase price allocation requirement under Ind AS 103, that is business combination. There can be impairment testing requirement, where again valuation of intangible assets can become a requirement. Transfer pricing, where an intangible asset is being transferred or licensed in and out between geographies, companies. Taxation by way of a purchase price allocation for claiming tax deductions when a business is transferred by a slump sale. Transaction, merger, and acquisition, when the subject is the intangible itself, such as brand, telecom license, or carrying out a pre-deal price allocation. Financing, when an intangible is used as collateral. Litigation, when there have been a breach of contract rights and compensation has to be determined. Bankruptcy, restructuring, etc. Insurance is also an opportunity or a requirement for valuation. Issuance of sweat equity shares, which are generally issued against technical know-how, technical expertise. There again, ICA valuation standards come in handy because intangible assets need to be valued. The principles enunciated in these standards shall be applied in conjunction with principles prescribed and contained in the framework for the preparation of valuation reports in accordance with ICA valuation standards. So the scope, the standard shall be applied for valuation of identified intangible asset for the given purpose of valuation. So some intangible assets may be contained in or physically substance. So this is how basically intangible assets are defined, that intangible assets can be part or can be, contained in a physical environment, but eventually you say that the value of those assets is coming out, or the value is lying in the fact that these are not tangible, these are not something that I can give to you, or the value is not in the asset itself, the value is stored in maybe stored in intangible asset, or maybe not even stored in intangible asset. It is something which cannot be seen. This is how we say that. So for example, it says computer software for a computer controlled machine tool that cannot operate without that specific software is an integral part of the related software, related hardware, and it is treated as an intangible asset. The same applies to the operating system of a computer. So if a computer is there and has an operating system installed on it, then that operating system is part of the computer. So when the software is not an integral part of the related hardware, computer software is treated as an intangible asset. So it depends whether the software or that asset is part or integral part of a tangible asset or not. If it is integral part of that asset, then it is already included in the value of that asset, or it is already part of that asset. So you won't say that this is an intangible asset which is separate. Now, with respect to valuation basis, valuer must consider the relevant valuation basis. So, what are the with respect to the valuation basis? We talk about market value, synergistic value, equitable value, and so on, liquidation value. So, we already talked about all those values. So, those bases they need to be considered even when you're considering intangible asset valuation. And you need to understand what will happen to this intangible asset in case liquidation happens. What will happen to this intangible asset in case market approach related valuation is required. So you will see the difference in the valuation basis, or the approach might change, the value might change depending on the different basis of value. Now, intangible asset is an unidentifiable non-monetary asset without physical substance. So this is how it is defined. And we have talked about what all can be an intangible asset. Now, intangible assets shall be able to generate quantifiable economic benefits for its owners and can be either directly owned through own business or purchased by paying royalty or license fees. Common examples of items of intangible assets are computer software, patents, copyrights, trademark, brands, motion picture films, customer list contracts, mortgage servicing rights, franchises, marketing rights, non-competition agreements, internet domain names, distribution network, literary works or musical works, telecom licenses, gaming platforms, trade design, licensing arrangements, royalty agreements, employment contracts, trade secrets. So this is a whole list of intangible assets which are possible, which are mentioned here. It's a pretty comprehensive list. An intangible asset is identifiable if it either is separable, it is capable of being separated or divided from the entity and sold, transferred, licensed, rented, or exchanged, either individually or together with a related content contract, arises from a contractual or other legal right, regardless of whether those rights are transferable or separately or separable from the entity or from other rights and obligations. So there can be two different parts. One is, can you separate something? So question, can you separate a patent from the company's assets or from the company's business? Yes, you can. Therefore, a patent can be a different asset and it can be part of a separable asset. But can you talk about, let's say, the value of a power purchase agreement that a thermal power plant enters with a prospective customer? Or maybe, maybe you have some contracts with your customers, some contracts with your vendors. Can you really say that, yes, these assets I can transfer? Are these transferable rights, such contracts? No, they are mostly not transferable. Mostly you will find power purchase agreements not transferable. You will find certain vendor agreements not transferable. You will find, employment agreements not being transferable. So these are certain limitations with respect to transferability, and even those which are not transferable are still intangible assets. But yes, they were based on contractual or other legal rights. This is how they are defined. So the definition of an intangible asset requires an intangible asset to be identified to distinguish it from goodwill. Goodwill is defined as an asset representing future economic benefits from a business interest, or a group of assets which has not been separately recognized in another asset. Goodwill is the difference between the cost of the business combination and acquirer's interest in the net fair value of the identifiable assets, liabilities, and provisions for contingent liabilities. In other words, goodwill is the residual value after ascribing values to identified intangible assets, other assets and liabilities. Goodwill can be transferable or non-transferable, right? So this is what we're talking about: future economic benefits that come from a business or a group of assets which has not been separately recognized in another asset. That is what we're talking about goodwill. That intangible assets, as long as we are able to identify those assets, we have done that. Other future cash flows that we are not able to explain or not able to allot to a particular asset, or rather pinpoint to a particular asset, will appear as a goodwill. Now, coming to categories of intangible assets. So this is very interesting. So customer-based intangible assets, marketing-based intangible assets, contract-based, technology-based, and then artistic-based intangible assets. These are how intangible assets are bifurcated. Broad categories are these, and these are not exhaustive. There can be other ways of classifying intangible assets, but this is a basic way where you would like to find, or you would like to understand how customer-based intangibles have common systems or common processes of getting or being valued. So certain intangible assets within the same category have certain similarities, and they also can have differences based on ownership, market position, function, and image. So this is how it kind of works for intangible assets. Now, customer-based intangibles are those which are created with an entity establishing relationships with its customers in the due course of its business. Such intangibles may be contractual or non-contractual. So, any examples of customer-based intangibles that you can think of? If you start thinking, what can be customer-based intangibles that you have? If you're a chartered accountant or if you're into finance, if you have, or maybe your number is saved with, let's say, a client of yours, is that a customer based intangible? Yes. If you have a contact of your customer or a phone number of your customer where you can call up the customer and kind of build a relationship with them, that's again a customer based intangible. Let's say empanelments. In case you're empaneled with some bank, with some agency for doing something, that's again a customer based intangible, right? Because you're looking at that what is the basic idea? That the intangible asset is coming in from your relationship with customers. So in case you have an existing customer who is a constant customer who kind of keeps giving you work every year or every month, whatever, then that's a asset because you are connected to him and somebody else is not. So therefore, you are able to add additional value in the business through that mechanism, right? Then examples of customer-based intangibles can be customer contracts, customer relationships, order backlog, or customer lists. So these assets can be valued as customer-based intangibles. Coming to marketing-based assets or marketing-based intangible assets, so marketing-based intangible assets are created with the involvement of business, and such intangibles are also used for further growth of business through marketing. This can be trademark, brand, trade name, internet domain, or trade design. Contract-based intangible assets. So contract-based intangible assets are created from the rights arising from contracts in business. These can be lease agreements. Somebody can say, oh, look at this. I have a lease agreement which stipulates that I will only pay 50% of the market rent. Now, is that an asset? Yes, certainly, because when you make profits from that asset or when you make profits from that address, those profits are not going, those profits will be higher because you're paying lesser rent. Non-compete agreements, license agreements, royalty agreements, employment contracts, these all can be classified as contract-based intangible assets. So non-compete agreements, how do they become intangible assets? Because you are here saying when you say non-compete agreements, you're looking at the possibility of charging a higher price from your customers because you have such a non-compete agreement. If you have a licensing agreement, how does that add value? Maybe you have a license to manufacture or rather license to make a software or license rather to operate a franchise. So these are licensing agreements where you have certain license and therefore based on that license you're able to work. Similarly, you can have the license to maybe run a software. So that can be a licensing agreement. Royalty agreements. What are royalty agreements? You have a brand, you have something where you have then asking for royalty from somebody else. So let's say technology related royalties are also there. So, maybe some Indian companies or some Nepali companies would be giving royalty to other companies for use of some kind of, brand. Maybe Dabur Nepal is seeking, paying royalty to Dabur India for the brand name that is used by Nepal's Dabur, right? So similarly, something like that. Employment contracts can be there, where you have contracts with the employees. You have an assembled man force, and then that can be used in this manner, assembled manpower. Technology-based intangible assets. So technology-based intangibles are those intangible assets that create proprietary knowledge. So what can be these? These can be patents, know-how, trade secrets, copyrights, processes, software, designs, or formulae. Artistic-based intangible assets can be films and music, books, plays, copyrights. So these are artistic-based intangible assets. So, what are the significant considerations that you would want to put before valuing an intangible asset? You would want to determine the purpose and objective of the overall valuation assignment. You will consider the legal rights of the intangible asset to be valued. For example, a registered trademark may have a higher value as compared to an unregistered trademark. However, an unpatented technology may have a higher value than a patented technology. So this is an example that they have given, that it can differ based on asset to asset. To evaluate the highest and best use considerations, to assess the history and development of the intangible asset, to consider any specific laws or regulations guiding the intangible asset valuation in the country. For example, royalty payments in India are regulated. So this is how we have certain considerations that need to be taken care of when we are valuing intangible assets. Uh, based on the industry knowledge, based on industry practices, these can be there. Economic useful life, so intangible assets could have finite or indefinite life, where finite life will usually be established by law. So maybe a book will have a will say have a trademark right for let's say 100 years. A movie will have it, let's say, for 50 years. A cinematic movie. So this way, in case you look at the information, sorry, IP Act, in like IP Act will give you details of what are the periods for patents or trademarks or copyrights or various assets that are where the information where the intellectual property can be secured. So therefore, that life depends on that contract or that life given by the law itself. Economic life, on the other hand, can be very, very different. How can it be different? Let's say maybe a book is not so popular, and maybe the book is on, let's say, IBC, and you have a trademark on it. Now, an IBC book, in case you don't renew it, in case you don't revamp it every few years, might be redundant, and you might not have any sales at all after 6, 7 years, or maybe even earlier. So therefore, the life cycle kind of is economic life is lesser, whereas the trademark that you will get with respect to that book will perhaps last for 100 years. So therefore, it is important to understand how economic useful life can be very different from the actual life of that intangible. The economic and legal factors shall be considered together as well as individually while determining the useful life of an intangible asset. Economic factors determine the period over which future economic benefits will be received by the entity. Legal factors may restrict the period over which the entity controls access to these benefits. The useful life is the shorter of the periods determined by these factors. So economic life versus legal factors, legal life, whatever is the shorter, that is what you will consider as the life of the intangible. That is what effectively means from what we're talking about. Now, economic life of customer-based intangible assets is to the extent dependent on is to an extent dependent on the attrition. Attrition refers to possible expected loss of customers, which is based on historical behavior of customers. Historical attrition can be based on the following. What can it be based on? It can be based on variable loss rate. It can be based on constant loss rate. And basically, the attrition that you're looking at is a direct it has a direct implication of the intangible asset that you're valuing. Let's say today somebody says, I have a customer related intangible. I have, let's say, contacts of 10,000 people who are my customers, and I, on an average, make X rupees per customer as the money that I make from them. And therefore, I don't need to market for those people or spend on marketing on those customer related intangibles. And therefore, that is the value of my customer related intangibles. So, how can we give it a value? We can say that, okay, let's say Lenskart or maybe any other company in India who's having a very strong customer intangible. Let's say they have 1 lakh subscribers or 1 lakh people who downloaded their app. Now that's a customer related intangible that they own, right? Now, but in case out of those 1 lakh people, the historical data says that about 10% vanish every year or 10% disappear every year. They don't continue with the app being downloaded on their system. Or in case you say that, okay, you have a you have downloads on this phone, you have, people downloading the app, but people are not using the app. So how do you weigh all that? There is a process called monthly active users, weekly active users, daily active users. Then you see these numbers and then you kind of try and find out, oh, this is the number and it is increasing or decreasing, and then you try and value the intangibles based after taking into effect these losses. So this is what we're talking about: variable loss, which is dependent on age of the customer relationship, and constant loss, which is calculated as a percentage of previous year's parameters. So these parameters can therefore be used, these historical attrition-based parameters, to try and avoid the possibility of overvaluing the intangibles by, kind of anticipating certain benefits which may not accrue in future. Then it comes to discount rates. So discount rates, as we must have already read in other parts of the ICA valuation standards, that discount rates would normally flow in from the investor's perspective, which takes care of, one, the alternative investments, number two, the risk that is inherent in the investment. So normally we find intangible assets driving a higher discount rate than the business as a whole. Why is so? Because as a business as a whole, you have maybe many de-riskings that are happening because of things overlapping each other. But when it comes to a specific intangible asset, then the risk parameters go high for somebody. So somebody wants to value the customer related intangibles of a company. Now there the risk which affects the customer related intangibles may be higher, and therefore the discount rate will perhaps also be high. Discount rate shall be indicative of risk associated with the cash flows arising from the intangible asset to be valued. Some of the factors which should be considered for determining the discount rates are: generally, intangibles have relatively more risk associated than tangible assets, a group of assets, or a business as a whole. Why? Because the risk is not being mitigated by the presence of multiple factors affecting the business. So one, if therefore the risk is higher. Intangible assets have a higher economic life and have more risk associated with than the intangible assets having a lower economic life. So that's the second principle. And the third is intangible assets with definite and determinable cash flows have relatively less risk associated as compared to intangible assets not having determinable cash flows. So the following discount rates are most commonly used. Weighted average cost of capital of the company or market participants can be used as a discount rate. Cost of equity for the company using intangible assets or market or participants can be used as a discount rate. Cost of debt, risk-free rate, interest rates which have maturity similar to economic life of the intangible assets. So these are the options with respect to what discount rate can be used for the purpose of valuing, or rather discounting, the future cash flows that come in from the value from the intangible asset. The discount rate is commonly considered with necessary premiums or discounts to arrive at the appropriate discount rates for intangible assets to be valued. Then there is weighted average return on assets. So VARA can be always be a method that the valuer can execute to confirm the reasonableness of discount rate or WACC to be considered for valuation of intangible asset. So that is, it is the expected rate of return on a particular asset and can be determined based on the riskiness involved for a particular asset. That is something that can be done. Tax amortization benefit, of course, whenever we look at possibility of having or adding an intangible asset, there's a possibility of using tax amortization or amortization on those assets to kind of to depreciate those assets and kind of claim income tax benefits. However, recently, when you have a bought over intangible asset, then it is difficult to kind of have any tax benefits associated with that. But in case there are some places where the regulatory body allows for taxation to be reduced on taxation benefits from intangible asset acquisition, their tax amortization benefit adjustment is normally done by those values. Now, you can then look at valuation approaches and methods. So we have gained all three asset approaches, or all three valuation approaches are here. So we can now talk about the specific market related approaches. So market approaches is a market approach that uses prices and other relevant information generated by market transactions involving identical or comparable assets. So valuation of intangible assets using this market approach is based on certain market transactional activity. Now, when we talk about comparable transactions for immovable for intangible assets, there is a difficulty with respect to finding like comparables. Now, in case you want to compare a brand with another brand and you want to kind of, start listing down all the parameters that make them different. Now, today you can say that, okay, let's pick up a brand like, let's say Sunfeast is a biscuit brand in India versus, let's say, we can say Parley, which is again, Parley is having multiple sub brands, but yes, we can say that yes, Parley is another brand. Now, when it comes to comparing these brands, there can be a host of differences in these brands, right? Where you can say that one brand is having presence in, let's say, 1,000 cities, the other brand is having having presence in 600 cities. The turnover can be different totally. The kind of market, the placing, the market placing can be different. Now, if you know that many companies now have multiple brands for multiple economic sectors in the country, in the society. So there will be a premium brand, a super premium brand, and there will be a less premium brand. So there is Patanjali Premium, there is a Patanjali normal Patanjali toothpaste also, which is Dankanti. Then there is Dankanti Silver, Gold, or whatever. So those are pricing methods that make the brand different or the value different. Similarly, one can say that, okay, a brand like Tide is different from a brand like Ariel with respect to pricing. With respect to Surf Excel, it can be different. So the different brands can have different value propositions in the market, and that can also affect the values of those brands. So therefore, when it comes to comparing intangible assets, we of course look at pricing multiples, but comparing them on the same footing sometimes becomes difficult. So the common methodology in market approach can be price or variable multiples, capitalization rates, or guidance pricing method. So this method, so basically you kind of apply this method and make adjustments and try to make them comparable. Similarly, guideline pricing method. So again, you kind of look at an orderly transaction for a comparable intangible asset, and then try to find what kind of pricing, what kind of values can come out of that approach. Income approach is the most used approach with respect to intangible assets. And that is, of course, very true because income approach can be applied as long as you have the unique features or unique cash flows from that asset and you can identify those cash flows. So, income approach becomes a usable approach as long as that is feasible. Therefore, it becomes important for us to understand all the methods under income approach which can be used. So these are those common methods that I use. This is called relief from royalty method, multi-period excess earnings method, with and without method, or premium profit method, greenfield method, and distributor method. So what do we do under relief from royalty method? As the name suggests, the value of the intangible asset is determined by estimating the value of total cost saved that would have otherwise been paid to the user as royalty payments if had been taken on lease from another party. Alternatively, it could be also indicate the value of an intangible asset that could have fetched cash flows in the form of royalty payments had it been leased to a third party. Any associated cost expected to be incurred by the licensee needs to be adjusted from the forecasted revenues. So basically, you're looking at what? You're looking at a possibility that, okay, let's say Maruti Suzuki has, maybe Maruti Suzuki has a brand with it. Now, Maruti Suzuki brand, had Maruti Suzuki not been owning the brand and had not been owning the brand, then what kind of royalty would it had been paying? So, what we are saying, what is the change in the cash flows in the future in case we say that Maruti Suzuki would have had to pay royalty on whatever Maruti Suzuki brand is coming or taking or bringing in. So that difference can then be the value of the brand itself. Similarly, it can be extended to, similar possibilities where, say, let's say we have a technology or I own a technology and I'm using that technology to make money. Now, in case I say that this technology can be, if I would not have been having the technology and I would have been paying somebody royalty to acquire the technology, then that royalty's cash flow or that royalty's present value will become my value of that royalty, right? Something like that. So this is what we're talking about here. So what are the steps here? You obtain the projected income statement associated with the intangible asset to be valued over the remaining useful life of the said asset. The value of the intangible asset to be valued is determined by first considering projections of royalty income adjusted with associated expenses like maintenance or marketing relevant to the intangible asset to be valued for its estimated useful life. Forecasted revenue is royalty computed as a percentage of revenue using an appropriate royalty rate. Where do you find this royalty rate? You try to find out market comparables. You say, okay, in the market, there is this company which pays royalty to this company for these services. And if that company is paying, let's say 15% or 20%, then my company will also pay 15-20%, and that will be your comparable number. Then analyze the projected income statement and its underlying assumptions to assess the reasonableness. Select the appropriate royalty rate based on market-based royalty rates, similar intangible assets. Apply the selected royalty rate to the future income attributable to the said asset, and then use the appropriate marginal tax rate. Discount the after-tax royalty savings to arrive at the present value using an appropriate discount rate, and then finally you adjust for tax amortization benefit. So this is how you kind of then compute the current or present value of the cash flows that are attributable to the royalty, and you kind of use this relief from royalty method. Now, when it comes to then multi-period excess earnings method, what does this mean? The multi-period excess earnings method is used to value an intangible asset, which is a primary intangible asset of the business. For example, for valuation of two intangible assets, let's say customer contracts and intellectual property rights, MEM would be considered for valuation of one of the intangible assets, while the other intangible asset would be valued using another method unless both intangible assets are significant for the business. So what do you say here? You say, okay, let's say my total profit from a business is, let's say, 100 crores. Out of this 100 crores, I start identifying, okay, I want to value my intangible asset, which is my brand. And then you say that, okay, what are the other intangibles that I'm using? Maybe I'm using an assembled workforce. Maybe I have some contractual intangibles. Maybe I have certain other assets. You identify those assets and try to find out what value or what earnings would normally be used for the purpose of those assets. So let's say you have certain customer intangibles and you feel that, okay, these customer intangibles can be valued by me using relief from royalty method. So you value them using relief from royalty method, that, okay, if this royalty would have gone out, then this would have been the value that I would have been paying for those assets to somebody. Now, doing all this, you include or you reduce the earnings that are actual earnings of the company for all these these notional earnings that might have been going out in case you would have those assets or you wouldn't be owning those intangible assets. Whatever is the residual value, whatever is the excess earnings that come out of this operation, then kind of become your value um, for the primary asset that you're looking at. So this is how the multi-purpose excess earnings method kind of works. So what are the major steps here? You obtain the projections of the entity or the combined asset group over the remaining useful life of the said intangible asset to be valued from the client or the target to determine the future after-tax cash flows expected to be generated. Then you analyze the projections and its underlying assumptions to assess the reasonableness of cash flows. You you then look at contributory asset charges (CAC) or economic rents to be reduced from the total net after-tax cash flows projected for the entity with respect to the cash flows attributable to other intangible assets that we are trying to kind of we don't want to value. And the CAC represents the charges for the use of an asset or group of assets based on their respective fair values and should be considered for all assets excluding goodwill that contribute to realization of cash flows. You discount these incremental after-tax cash flows attributable to the intangible asset to the value, and then you adjust for tab, and then that is how you kind of try to value these assets. So contributory assets are assets that support the intangible asset to be valued to generate cash flow and are used in combination with the intangible assets to be valued. So CAC is widely used by valuers and refers to the return on assets reporting the cash flows generated. So as I said, you want to value the brand, you try to find the contributory asset charge with respect to, let's say, all the other assets. It can be contractual assets, it can be artistic assets, it can be other assets that you're talking about. So you reduce all those effects and then try to find, okay, this is the value that I still get for my brand. So, for customer-based intangible assets, a valuer needs to consider attrition, which refers to, so we've already talked about that attrition. Then we come to with and without method. So what are we talking about? We talked about relief from royalty. We have talked about the multi-period earnings, excess earnings method. We are now talking about with and without method. What it is with and without method? It's actually very scenario, very simple, where you try to find out two scenarios. What would have been my cash flows, or what are my cash flows where the with scenario is there? That is, the intangible asset is part of my business, and what would have been the cash flows in case my asset, or my that intangible asset, would not have been part of my business. So you look at these two scenarios and then kind of compare the cash flows between these two scenarios and try to find a present value with respect to those, that difference, that okay, in case on a period of, let's say, 1 to 10 years from now, I have, cash flows, let's say 100, 120 coming in from my business. If I say that these are my cash flows from my business, including the intangible asset, then I say that okay, out of this 101, 120, maybe let's say 30 will go out to outsiders in case I don't have this intangible asset. Then you kind of take that out and then try to kind of value that differential, that differential uh, uh, scenario, and the difference between those two scenarios with respect to the cash flows that might come in is what is then the value of my intangible asset. So with and without scenario is prepared, and the difference between those with and without scenarios with respect to cash flows are then the present value of that is taken care of in this manner. So these are mostly used for valuation of non-compete agreements and so on. Then greenfield method. What does the greenfield method say? It says the basic assumption for valuation using greenfield method is that the intangible asset to be valued is the only asset with all the other intangible or intangible assets being created, leased, or acquired. Instead of the contributory asset charge generally deducted from the cash flows, the valuer is required to subtract replacement cost of the asset that is required to be built or bought. So in case I say I have some plant and machinery, I have some land and building, I have some other assets which are part of my asset list. Now, in case I want to say that, okay, my value of my business is X, and out of this X, I will start reducing all these values or all the independent values and then see what is left out, then you kind of come at a value. So it is usually used to value franchise agreements and certain licenses, and then you kind of prepare the cash flows with the premise that the intangible asset is the only asset in the business, then project the related revenues, expenses, working capital, and capital, project the amount and timing of expenditure relating to acquisition, creation of rentals, compute the present value of the net cash flows using an appropriate discount rate, and then kind of uh, compute it, or charge for tax amortization benefit. Then it comes to distributor method. So this is a variation of multi-period earnings, excess earnings method, and is adopted for valuation of customer-based intangible asset when multi-period excess earnings method is applied to value other intangible asset considered to be more significant. So this is what do you do is you kind of prepare revenue and expenses projections on existing customer relationship along with relevant attrition, and then you determine the profit margins of the distributors who are comparable to subject margins. So basically you use a distributor method. You say that, okay, I have my customer intangibles with me, but if I would not have had those relationships, and if I would have been using distributors to market my products, then what would have been the share of profits that I would have to give to my distributors. So let's say the market says that, okay, distributors would normally get 20% of your sales. Then 20% of my sales using distributor method can become my value of my customer intangibles. So this is the distributor method that we're talking about. Now, cost approach, as I said, is talking about replacing the service capacity of an asset. Now, with respect to intangible asset, using the cost approach is based on the principal rule of substitution, as I said. So we have used in our office and in our company also, we have used cost approach in some cases where no information is available. So I can say that, okay, today in case there is an X brand which is there, Today I can say that, okay, if I spent this much money on advertisement and on kind of, making the brand popular, then that will be my value for that asset. So that is basically trying to find that what kind of expenditure will go into an asset to kind of try to find its replacement cost. So that is the value that you can give to those costs then. So reproduction cost method or replacement cost method is there, and then you adjust that for obsolescence, and you kind of try to kind of compute that value using this approach. So that's for intangible assets. These are again something which is already effective from 2018. So this is the replacement cost method and the cost method with respect to intangibles. I believe I can now take some questions. We have 10 minutes, last 10 minutes, we can take some questions and try to kind of make this interactive in the way that I can try and understand if there are any comments, any suggestions coming in from, any questions coming in from the participants, and that will be great.
Yes, thank you so much, Ankit for the session. So we've received one question as of now, and the question is, due to lack of country-specific data,
Mhm.
sometimes we need to refer to global data to understand the expectations of investors in that particular industry. To determine the discount rate taking the base of global data, what sort of method we can apply to adjust the discount rate while using DCF approach?
So when we say that we want to change the discount rate or adjust the discount rate for DCF approach, we are looking at certain economic factors that affect different companies. There can be inflation. So in case you say that, okay, there is a discount rate or the expected rate of return in the US versus what is available in India or Nepal, maybe you will have a lot of difference because the basic interest rate or basic interest rate from the banks or saving banks or risk-free interest rate is something which is very, very minimal in the US or as compared to in India and Nepal. So here the risk-free rate might be 7%, 8%, and 6%, and so on. Whereas in the US, it might be 1%. So that difference is also kind of then seen in the inflation rate that you have. So inflation is again a number that we kind of look at. So the difference in the risk-free rate and the difference in the inflation between the two countries is one factor that I would certainly adjust this for when I'm picking discount rates or picking numbers from other countries. I will also like to then try to understand the cycle or rather the phase of development of that industry in in that country. So for maybe an industry in the US, it might be a very very mature phase, whereas in case of India or Nepal, it might be a growth phase. So during growth phase, the risk is higher, the returns are expected to be higher, whereas as expected to a stable maturity phase, then the risk is lesser, the discount rates are also lesser. So I would like to make those adjustments with respect to the with respect to with that respect.
Thank you so much, sir. Thank you so much for sharing the great insights. And it was a learning experience for all of us, and I'm sure for all our audience also. We extend a sincere thanks to you, sir, for taking out the time and sharing your valuable insights with us.
Thank you, Shruti. It was a pleasure at my end as well, and it was lovely talking to at this and deliberating on this topic. It is of course something that we do on a regular basis, and therefore it came very naturally to me to talk about this subject. And I hope the participants benefit from this whole approach. Thank you so much.
Thank you, sir. Thank you so much. So this marks an end to our first part of day 5, and now we'll be starting with the next part of our session. And this session is being taken by CA Vikas Goyalji. He will be deliberating about distressed asset valuation and startup entities valuation. So our next speaker is about to join us soon. So if
Thank you,
there are
Shruti.
any
Yeah, thank you so much. I will be exiting the meeting. Vikashji, good to see you. And
sir, your voice is not audible. So, dear participants, we have with us our next speaker for the day, CA Vikas Goyal ji. Sir, can you listen? Can you hear my voice?
Yes, I can. Yes.
Okay,
Am I
great.
audible to you?
Yes, you are very well audible. So we will start with our next session without any delay. Thank you so much, sir, for gracing us with your presence. And after an insightful session on equity business valuation and valuation of intangibles, we move forward to our next part of our day. Vikas Goyalji is currently associated with Omnifin Solutions and Omnifil Valuation Services as a director. Sir, you are an independent registered valuer with IBBI, a fellow chartered accountant, a CFA. You are an alumni of IIM and St. Xavier's College, Kolkata. Sir, you have an extensive experience of close to 17 years spanning across industry and consulting, and your association has been with companies like PwC, EY, ICA, and ZAC Research in India and Canada. You are a first generation entrepreneur and specialize in transaction advisory from M&A to valuations and financial due diligence. You have conducted hundreds of valuation engagements for startups as well as for large conglomerates. You've also authored You've also authored two books on valuations, which are widely acclaimed, and you are also an active trainer, having delivered training on finance, valuation, and behavioral skills at various institutions of repute and corporate houses. Thank you so much once again, sir, for gracing us with your presence. Over to you, sir. We are eager to hear from you.
Thank you very much, ma'am, and good evening to all of you, all the participants. It's always an honor and pleasure to be able to share insights. And of course, while we deliver sessions, we always take back a lot of information and learnings ourselves as well. So, and once again, thank you for the introduction as well. I mean, that's pretty warm. So I'm going to share my screen right away, and then we will start talking about. Sorry, just one second. Please let me know whenever you can see my screen.
Yes, sir. Your
Can you see
screen
the
is
screen?
visible.
Yes. Okay. Great. So, so we will start. We'll talk about startup valuations, and depending on how much time we have, we will briefly touch upon valuation for distressed companies as well. But considering the time that we have, I believe we will be able to cover more of startup valuations and just a summary of distressed companies. Right. So we do a lot of discussions around startups. I mean, it's the buzzword around for a reasonably long time now. And while we're all trying to value businesses, and I understand that Ankit ji did talk about valuation of equity shares in businesses, but there are some typical things that happen when we talk about startups. And I must talk about the technical aspects or the typical aspects of valuing startups as well, right? So, so I'm sure everyone here uses WhatsApp, right? And I'm not sure how many of you are familiar, but WhatsApp was acquired by Facebook in 2013. Now, uh, at the time of acquisition, Facebook paid $19 billion to acquire WhatsApp, right? And while $19 billion was a mixture of cash and stock, so if you really look at it, after the acquisition was announced, Facebook stock went down. So the effective consideration that went out for the acquisition was about 17 billion. So nevertheless, the point is that there was a reasonably high value, right? So we had 19 billion, you call it 17 billion, right? But that's the figure that WhatsApp was acquired for. Now, very interestingly, uh, do we all use while we're using WhatsApp, right? I don't know how many of us pay to use WhatsApp. I don't, and as far as I'm concerned, most of us do not pay anything to use WhatsApp, right? It's a service, it's an application, and that's available to us for free. It's a free chat app. Now that brings us to a question in mind, right? That is, anything in life free at the end of the day? right? So if we are not paying to use WhatsApp, somebody must be paying somewhere something, right? Now, WhatsApp has been around for a reasonably long time. Now, but when we used WhatsApp before 2013, before the acquisition was made, it used to say that it is free for the first year, and then you will have to pay 60 rupees or $1 every year. But nobody ever paid. If you go back, I mean, I'm talking about something that was more than 10 years old, right? So in my memory, there's nobody who's ever paid to use WhatsApp, at least till the time of acquisition. So if you look at the numbers, right, whenever we do valuation, there has to be some numbers behind those valuation figures. So at the time of acquisition, WhatsApp had 450 million users. It showed a revenue of $10 million, right? And here we are talking about three zeros of difference, right? So a billion would have 9 zeros, a billion would have 6 zeros. So $10 million of revenue, and it reported a loss of 138 million in the previous year, right? So just imagine, for a company whose revenue was only $10 million, had a valuation of $19 billion. We're talking about 1900 times of sales. That's the valuation multiple. Now it is very interesting to understand why would Facebook pay such a huge value to acquire WhatsApp, right? Very interestingly, there are some public domain news which says that Google had bid to acquire WhatsApp for only $1 billion just before the acquisition happened. Now, of course, those are unconfirmed news, but if that's true, does Google not know how to do valuation of a company? Because if Google is coming with a valuation of 1 billion and Facebook is acquiring the same company for 19 billion, imagine the difference in valuation of startups that we are talking about, right? So the first thing I want all of us to understand is that when we are talking about startups, we can price startups, but it's very difficult to value startups, right? You can assign a price tag to it, that okay, this is the price I would pay to get a stake in this company, or this is the price I would charge to sell my company or sell my stake. But that may not be a value of the startup or of the company, right? Because whenever we do valuation, there has to be a story behind that valuation. And for any matured company, the story is by and large established, right? I mean, the introductions and all of those are made. But when we are talking about a startup, we are just talking about the trailer. So you don't know what's there in the movie, you don't know what's the story, and the story can take twists and turns in the future, and you would never know that. So maybe if we have time, we'll talk. I don't know if we will have time to talk about how that valuation came up. But in reality, see, because it was acquired by Facebook, there is a 10K that Facebook had to report, right? The 10K is equivalent to the annual report in the US. And 10K said that the value, right, of the company was still around 1 point something billion. And then there was a goodwill of around 15 billion, right? So if you really look at it, the valuation of WhatsApp was not 19 billion or 17 billion. The valuation was still around 1 billion, but the goodwill was 15 billion, which is not the value of the company. It is a premium that an acquirer is paying to acquire another company, right? Just the premium. So you can imagine, if you did not have the 10K, we would assign WhatsApp evaluation of 17 billion. In fact, we'll touch base on that number in some time. Okay. In today's session, we will touch base on that. So I wanted to share this brief story around startups, right? So what is a startup at the end of the day? A startup is a company which would have some very typical features, right? A startup is something which would be involved into innovation. It is going to create something. The risk is going to be very, very high, right? So a startup is a very typical organization which is in the early stages. It is feeding on innovation, creativity, and risk taking, right? A lot of times people confuse startup as any new organization. No, if you incorporate a company today which is into a legacy business, it might classify as startup in the technical sense, but it's not startup as far as valuation is concerned or the investment ecosystem is concerned, right? So for example, in India, there is a definition, there is a criteria for a startup, right? And this criteria is becoming very popular across the world. So it's saying that it should be up to 10 years from incorporation, so less than 10 years of age. It can be a private company or a partnership or an LLP. It should have a turnover of less than INR, Indian rupees, 100 crores, right? It should be working towards innovation, development, or improvement of products or processes or services. And it should be a scalable business model. Now, again, It should be a scalable business model. It does not have to scale, right? Because the startups will fail. So if a startup doesn't scale, it fails, right? But at the end of the day, these are the factors that would be considered while classifying something, an entity as a startup. And then it also says that it should not be carved out of an existing business, right? It's not mentioned on the screen, but it does say that it cannot be a company which has been restructured from an existing organization or carved out from an existing organization. No, it has to be a brand new entity in every sense of the word, right? And in India, SEBI has adopted the same definition under the AIF regulation. So that's what a startup is usually referred to uh, when we talk about investment world, right? Now, of course, this definition has got nothing to do with what you would do with respect to valuation. This is going to help you understand that, hey, it still falls within the ambit of being a startup. Okay. But again, it has got nothing to do with valuation, because a company can still be 25 years old, but it can still be a very, very, it can still fulfill all the other bullet points, right? So we need to understand what is startup from a valuation standpoint, right? So that's only the legal definition for getting tax breaks in India. Basically, any company that's constantly innovating, pivoting is practically a startup, right? Not just any new company that's not doing something different. Okay. So what is typical about startups while valuation? Right? We have to understand that. So I'm sure everyone realizes that there's something called a life cycle, right? And this life cycle is by and large common in most of the things, correct? It is common in our careers, it is common in life, it is common in our health, it is common in businesses as well, right? So we're talking about this is and this is the time period, right? This is time, and this could be anything. This could be revenue, this could be value, this could be profit, anything, correct? So this is a typical life cycle. So we are saying that a startup is something which will be in this stage, right? This is a stage it's going to be in, and that's it. Till this point, it's going to be a startup. So it is basically a young company, a less mature company with fewer employees, lower assets, and minimum capital. That's it, right? So a startup would be a less mature company. It will be smaller in size. It will have higher levels of risk. It will have limited access to capital markets, right? And now think about it. When you're talking about a company which is smaller in size, and we will talk about it. I'm sure you're already familiar with market capitalization, you're familiar with market multiples. Now, to value a company, I might refer to some peer companies. So let's say if I'm valuing a company which is in the technology space, and I'm looking at the likes of Google or Infosys. I mean, they are in different businesses completely, but if you're looking at some of those very matured large organizations, right, the same multiple would not apply to a very new company. So there, if you're using a multiple, you would also have to apply a small size discount, right? Or you would increase the discount rate, or you will reduce the multiple when you are applying that comparable. Okay. So it is of relatively smaller size. Then in case of startups, most often you will see that there is overlap in shareholder and management, correct? I mean, think about it. If you're looking at, let's say, a Tata Group in India, or you're looking at an Infosys in India, etc. So there, the shareholder and the management are very different, right? I mean, in most professional organizations, the shareholder and the management is different. The management are the agent of the shareholders, and shareholders are the ones who are basically there to get the benefits out of increases in share price. But in case of startups, it's usually founder driven, correct? So shareholders are the management, and therefore there is less agency problem. The bigger problem in case of startups, which really affects valuation, is this. It is the quality of financial information. There is complete lack of reliable data. It has got lower history. It has got discretionary spends. It has got questionable financial reporting, and it also focuses on reducing taxes. Now let's understand what that is. Okay. So when you're talking about a company which has just started operations, the founder is the one who's running the show. The founder cares about enhancing the value of the business. But at the same time, in the process of doing that, the founder does not have the time to really look at the compliances and financial reporting, may not even have the capability to do it. The founder at the startup stage cannot afford very qualified professionals, chartered accountants, and large audit firms, and so on. Correct? So what happens is there's a lot of unreliable data that creeps in. For example, who is going to question the startup founder as to how much salary he is taking or he is not taking? Okay, that's a questionable thing. Now, in a lot of cases, you will find that startup founders are not taking salaries at all. Now, just imagine when you're valuing a company and you're valuing a company from a fair value perspective, you and the founder does not take salary. Don't you think that the profits are overstated? They are, right? Because there is a resource that that company is utilizing. That resource is the time of that founder. And that founder could have been a person who's an extremely experienced person. He might have been in a C-suite level in his previous organization, drawing crores of rupees of salary, and is not charging any salary to the current firm. So in that case, what happens? The profits of the company is exaggerated, is increased, because there should have been a salary expense which is not charged there, and therefore the profits are overstated. So even if there is a loss, the losses would have been far more than what it is reported there. Correct? On the other hand, the founder, because it is his own firm, there's nobody questioning him, he can be taking very high salary from the company, right? And this would happen when the founders have already got an investor and investors have put in money into the company. The founders start taking salaries, and that salary can be very high. Also, let's talk about some discretionary spends, right? So what do you mean by discretionary spends? The founder could be investing or could be spending money in areas where he should not be spending money, right? Because nobody is questioning him. There are no outside investors who are questioning the founders on those spends. Correct? So, for example, he might charge a lot of his personal expenses into the books of accounts as well. He might invest into marketing areas which are not approved by anybody else, but he says, okay, I like to do it, I'll do it. Or my gut says that we should do it, etc. So there's a lot of discretionary spends, right? That goes into the financial statements. So as a valuer, we must understand that the financial statements that we are getting from the startups are or may have a lot of things to work upon, right? We need to do a due diligence of those financial statements before actually taking those numbers at face value. Okay, so the quality of the financial information is oftentimes not as good as it should be, and that's typical about startups while valuation. So when you look at the now, I spoke of the life cycle of the company, right? And we said that there's this curve that goes in any life cycle. So how would you value the company depending on what life cycle it is in or what stage of the life cycle it is in? So if you're talking about companies which are in the earliest stages, right? Now they should be valued using the asset-based approach. And I'm sure many of you will immediately have questioned that, Vikash, we have seen companies getting very high value before they have even started operations, which is true, right? But those are not necessarily fair values. Those are values which have been negotiated with a potential investor, and the investor has bet on the management or on the idea and not on the business based on the numbers, right? But what is asset-based approach? So let's understand. And we will have examples of explaining this, right? We will talk about explaining this. So a company which has just created an app, right? And it says, let's say we will have so let's say they say that this technology is going to help me. Let me think of something. This technology is going to help the student, help an institute correct all the student answer scripts automatically using artificial intelligence, right? So the students are writing the answers in pieces of paper. You scan the pieces of paper and automatically it will go through our software, and the software will automatically identify the question. It will identify the answers, including the student handwriting. The machine learning has allowed us to read the student handwriting very well, right? And using artificial intelligence, we will know what should be the right answer. The answer could also be uploaded by the teacher, and depending on how close it is to the answer, we will grade the students, right? And it can happen in mathematics, it can happen in geography, it can happen in history, it can happen in English, it can happen in accounting, all of those things. Now that's the promise that that software is doing, right? So, but the software has not started generating revenues today. So what do you do in that case? If you look at the life cycle of the company, is the company having an idea? Yes. Has it started working on that idea? Yes. Do they have a software in place? Yes. Is the software something which is not very common in the market? Correct. Has the experiments been done in the software? Yes. Has it started generating revenue? No. So here, the company has made a lot of progress in terms of research and development, but has not started generating revenue, right? So I will still give it some premium because it's a fantastic idea and they have made some research around it, but I will not assign it crores of rupees of value, for a simple reason, because we don't know whether the company has established a product market fit or not. What if the teachers don't agree to this kind of a software at all? The company is not going to survive, right? So what if the handwriting is not the handwriting is not being read carefully? It will not be able to survive. So on the other hand, let's say I say that I'm creating an application which is going to use chat, where we will be able to use chats, right? And like a chat based app. There are hundreds of apps which are there which facilitates chatting. And here you would have spent some lakh rupees to kind of facilitate a chat, right? Or develop a chat box. But I would not be able to assign any premium to it because there's nothing new in it, right? So in those cases, I'm going to simply say, how much money have you spent on this, on the development of this app? And let's say if they say that we've spent 1 crore rupees, I'll say, okay, that's the value, because anybody can redevelop this at 1 crore rupees, and it does not have a significant value creation, right? So I'm going to assign only 1 crore, maybe a little more than 1 crore, because you will be saving my time if I acquire it, but that's about it, right? So we will use asset based approaches in case of early stage companies, very, very early stage companies, those which are in the ideation stage and so on. The second is the companies which have established a product market fit. Now, this is a terminology which we often use in case of startups. We call it the PMF, or the product market fit. And this is where we say that the company has successfully negotiated early development stage and is witnessing high growth, right? So the company has started generating revenues. The company might still be into losses, mind you, but the company has started generating revenues. And now it has got some headway. So in that case, we will value these companies using income approach. We can still apply plus market approach, right? We can still apply market approach in that case, but you know that we will be valuing these companies in a much more matured manner than just the balance sheet values. And third, you have matured startups. Now, the startups which have reached this stage, right? The startups which are in this stage, which is matured startups. Here, we should be valuing the company using market approach or income approach or both, right? So until and unless the companies have established their product market fit, you would not apply the income approach to value these companies. And now there will be stages, and let me quickly talk about what happens to companies which are not doing well at all, right? There will be companies which are in this stage. These are, we call them as distressed companies. And distressed companies would again be valued based on net asset value, based on their balance sheet values. We know that these companies are not progressing further. These companies may not be revived. These companies are under distress. They may be revived, but what's the probability of that? You might want to assign that. But if the companies are at this stage, we will value these companies as distressed companies. Again, we will go to the asset-based approaches, and that's how we will value them. I'm not sure if there is a way to take questions. I'm not sure if because it doesn't show me how many participants are there. But yeah.
The questions will be routed through me. Whatever questions they come up, I will ask you.
Okay, so yeah, so to all the participants out there, you might want to use the chat window to ask questions. And instead of taking all the questions at the end, maybe I will take 2 or 3 slots, right? So if you have questions in mind, you might want to type that, and maybe 10 minutes from now, we will take some of the questions that you might have, so that you don't have to sit on it for a long time. Okay. So now, what happens when we're valuing startups, right? So if you are a professional and you are valuing a startup for a client, right? Now we say that every valuation has to have a story behind it. Every valuation has to have a story. For example, even if we talk about this, right? So a company is in distress. Can you still value the company using going concern? Yes, you can have a story saying that we are in distress now, but we have got an investor who's willing to pump in more money, and we have got ideas which we can implement now, based on which the company can be revived, and we will still operate this company on a going concern basis, right? I call it the undertaker syndrome. We had that WWE, the wrestling federation, where there was this wrestler Undertaker who would go down and then he would rise up again from the ashes, things like that. So if there is a story, right, there is a story. So your valuation will change depending on the story, but you should not fall for the VFXs, right? You should not fall for too much of animation around it. So do not hide behind the management forecast, because as professionals, if we are valuing a company, we own the value, right? We have to be responsible for the value that we are giving. We cannot say, and in fact, even international valuation standards say that, and including ICAI valuation standards, they all say that, we cannot just hide behind the forecast that the management has given us, right? So what happens? Evaluate the future of the company. Now, again, you could be wrong, and in fact, you will be wrong most of the time. But you must have your due diligences, your assumptions in place whenever you are doing a number, you're doing evaluation. So let's say you say, what is the future of the company? You see that the company may not survive in the long run, right? You feel that this, irrespective of whatever the founder is saying, but this business will not survive in the long run because it's a common business. And there's going to be a lot of competition, or people may not buy it, and things like that. You can have your own, you are always entitled to have your own story. Okay. So if you see that the company is not going to survive in the long run, you apply a probability of default. Now, what do you mean by this? Let's say you will say that there is a value as per going concern, plus there is a value as per default, right? So you will multiply this with probability of going concern, and you will multiply this with probability of default, right? And that will give you the value. You understand what I mean, right? So you will say, hey, what if the company is going to continue in the long run? This is the value, but the probability of this company going through in the long run is only 70%. So there's a 30% chance that this company will not survive in the long run. So if it is not going to survive in the long run, then the company, I would need to value this company based on the book value only, or the net asset value only. So NAV into 30% plus DCF value, or the discounted cash flow value, into 70%, and you get the value, right? Second, the company will survive and scale despite competition, right? So you may have a situation, you think that the company will survive and it will scale, right? Now, how will it scale, or how will it grow? It might scale on its own. So you say perpetual cash flows, right? I'm sure you're familiar with the terminal cash flow valuation. So you will say, okay, I have a forecast till 5 years, plus I have a terminal value. The terminal value is given by 5-year forecast plus 1 plus growth rate divided by cost of equity, or whatever the discount rate is, minus the growth rate. Okay. So you have a terminal value. So you apply the perpetual cash flows here if the company is expected to go on its own. You can also expect that the company will be acquired by another competitor, right? So for example, when you're doing the market analysis, you are seeing that, yes, this company is doing well, but at the same time, there are some very big players in this industry, and it's still an oligopoly market, right? So for example, in India, Jabong was acquired by Myntra. Okay. Very interesting case. So Jabong was a player in the apparel space. Myntra was also a player in the apparel space. Myntra was a bigger player than Jabong. Jabong was doing okay, and it was still fighting well. But at the end of the day, Myntra acquired Jabong, and Myntra itself was acquired by Flipkart eventually, right? Now, I'm not saying that the value is going to go away. I'm just saying that you will still get a very reasonable value there, right? You apply an exit multiple in the terminal value. So basically, I'm saying that the terminal value can have two options. Either you can calculate using perpetuity model, or you can calculate using the the multiples model, right? So this is both going to give you the terminal value. Okay. Now, just to give you a perspective around how companies operate at different stages in the life cycle. So if you divide the whole life cycle into 6 stages, you will see that in stage 1, there's no revenue, right? Let me change the color here. In stage 1, there's going to be no revenue. Stage 2, there is no revenue. Stage 3, there is no revenue. Stage 4 is where company starts generating some revenue. Stage 5, it is growing. And stage 6, it has got established history. Expense history, you would have limited expense history because it's very, very new. You have substantive history till stage 4, and then you will have established history from stage 5 onwards. Profitability, you will eventually see losses. Probably stage 5 is where the company is going to break even, right? So what happens when you are valuing the company in this stage? They are all making losses. Okay. And stage 6, there's going to be established history of the company. Now remember, at this point, there will still be carry forward losses, right? There can still be carry forward losses. So even if the company is making profit, there would be carry forward losses that will be applicable till stage 5. Management team would be incomplete at this stage. Only the founders are there. It is expanding, and then stage 3 onwards, it should be complete. Product development, there's limited product development. It is underway. This is beta testing. Now see, when there is some revenue, that's where you would start having order fulfillment, correct? And then stage 6, it's going to be ongoing. Now, how do you finance these companies? You will see financing is usually done by angels or early VC. It is going to be venture capitalist stroke strategic, mezzanine financing, and strategic investor in IPOs, self-funding, and debt plus equity. So this is the life cycle of the company, and you will see this as trends in the company's life cycle over a 6-stage period. Now, this is very interesting, and this has come after a lot of research, right? We've tried to identify that as a valuer, they will. Okay, so let me take a pause here before we move further, right? Any questions? Any questions that, ma'am? Do you have any questions from the participants so far?
Not yet, sir.
Not yet. All right. Okay. We still have participants, right? Because I can only see 4 people in my screen.
No. So
Okay.
this is basically you can see the screen, but it's a webcast, so participants can see.
Okay. I get it. Thank you. Right. So now we always talk about biases in valuation. Now, would there be biases in valuation? Yes. Can you avoid biases in valuation? Yes. Would there still be some bias in valuation? Absolutely, yes. Right. I mean, you cannot do a valuation where there is completely unbiased valuation. But again, there is ethical bias and there is unethical bias. What do you mean by that? Right. An unethical bias, the bias that should not be there in the valuation, is somebody asked you to give them a value and you gave that value. That's an unethical bias. You need to be independent from an engagement standpoint, right? But what biases can be there? So there is a company which comes to you and you look at the numbers, right? And you see that no, there's something not right. There is something wrong in that number. There is something wrong in that calculation. There is something which is missing. And therefore you adjust the numbers, or you try to adjust the numbers, but the client is saying, no, we can't adjust the numbers, right? This is what we have given you. If you're looking at management representation, this is the representation. Then what do you do? In order to make the valuation realistic, you apply different methods, you increase the discount rate and things like that. That's the kind of biasness we are talking about. So when you get a company, right, how do you evaluate whether a company should get premium or not? So this model will help you understand whether a company should be assigned a premium at all or not, right? So how do you evaluate a company which is coming to you? So let's see, we'll start with this, right? So you evaluate pre-revenue startup, and this is a model that we've designed at Omnifin internally, and we use this for our engagements. So I thought, why not share it with you? So how do you see? You look at the 3 things first. You look at the business, you look at the market, and you look at the team. What is TAM? TAM is total addressable market. Okay, that's again a startup terminology. So you look at the business, the market, and the team. So when you say team, it will include the promoters, it will include the founders, it will include the management teams, it will include the teams on the ground as well. What kind of team do you have? What kind of market do you have? What kind of business do you have? This will include a lot of things, and I have covered what a business would mean, right? And that market would mean. We will talk about that. So once you establish that these three things are in place, they are good, then you come to the business. You say, is it solving any major problem? If no, if it is not solving a major problem, you should not assign a premium to it, because if it is not solving a problem, people are not going to like it. It will be a luxury product for the people, and therefore it might not scale the way it should. Okay. So again, it's subjective, but is it solving a problem? If the answer is no, you go here. If the answer is yes, you go to the next point. Is there huge scaling opportunity? Now again, you try to evaluate whether there is a scaling opportunity into this or not. If you say no, I don't see that there's a huge scaling opportunity, I will put it here. If there is, I will say, are there existing players? Now this is interesting, because people often argue with us that, Vikash, if there are no existing players, that means I'm the dominant player in that space, and therefore I should get a premium. And we say no, you shouldn't. And we have reasons to say that. Okay, we have reasons to say that. If you look at the first e-commerce company in the world, was that Amazon? No, that was not Amazon. Amazon was not the first, not the second. It started at nth number, right? It's not the first e-commerce company in the world. It's the largest today, but it was not first. Second, if you look at which is the largest e-commerce company in India, was it Flipkart? Largest, yes. First, no, it was not the first, right? If you look at, let's say, which is the so basically, you look at various examples, right? You look at airlines. Is Indigo the largest or the biggest player in the airspace in India? Yes. Is it the first? Definitely no. If you look at social media, is Facebook the largest social media company in the world? Yes. Is it the first? No, it's not. So the first players don't get the premium just because they are the first players. Second, you should also ask, if there is nobody who's doing this yet, there must be a problem why nobody is doing it. Why give them the benefit that nobody ever thought about it, right? And remember, this is not the first thing, this is not the only thing that we are discussing. It's like a scorecard, but you give them more points if there are existing players, you give them less points if there are no existing players. Now, if there are existing players, can the company sustain the cash flows and high margins? Because see, you will get high value when you have competitive advantage. So we are talking about competitive advantage, and we are talking about sustainable competitive advantages. Okay, is it going to sustain the cash flows and high margins? If yes, then definitely it commands a higher valuation premium. If no, it would go on the lower side, right? So here, if it is commanding high valuation premium, you use benchmark multiples, you take a lower discount rate, probably with lower probability of default. If it is not commanding a major valuation premium, you will apply the cost approach, you will apply income approach, but with a high probability of default, right? That's an important thing to consider. So this is a framework that we use internally to assign premiums in valuation. Of course, there are other factors that can go along, and we'll talk about some of them here. But that's how you can build or give objectivity to your biases. Okay, that hey, I have a framework here, and that's how I am assigning premiums. Okay. So in case of startups, what's different, right? And this is a slide that came from Ashwath Damodaran. He's the valuation. We call him the dean of valuation, the global dean of valuation. He says that in case of startup, what happens is that the revenue. So if this is 0.0, right, the revenues don't start here. The revenues start from here. And when you're talking about earnings, we're talking about profits and losses. So the earnings are negative, right? This is all loss zone. This is all loss. Right? This is very similar to the stages that we've talked about, right? So there's all going to be losses till this point, and this is where it will break even. So stage 1, stage 2, stage 3, it may not break even. Now, let me come here, and then I'll go back to the previous one, right? So when you say, how do you evaluate market? So you look at, let's say, competition. What are the barriers to entry in this industry? Is there differentiation? What kind of every founder will tell you that they have differentiation product, they have differentiated products, right? This is how they are different from the competition. But as a valuer, as a professional, we need to have our own judgments to that and not fall for the VFXs. Okay. So is this differentiation sustainable? how quickly will the competition will be able to catch up? And imagine we are in times of technology, and technology can really move very, very fast, right? So if one person can do it, somebody can quickly do it. Imagine all the startups, the large startups that are around you, right? Do you really find huge differences between them? For example, in India, what difference is there in Uber and Ola? Right? There's hardly any difference. They are all so similar to each other, right? If you, I mean, so look at all the companies, airlines. I mean, there are some factors which are culturally different, but otherwise, by and large, they would be different. So they would be similar. So do they have sustainable differentiation? Right? Is it a crowded space or what? Right? So look at the competition, the nature of the competition. Look at total addressable market. What is the size of the market, and how is the market growing? Right? So for example, in India, we are saying that fintech, it's an evergreen sector, right? It's working so well in the last 2 years, since the last 2 years, and it is continuing to do well even today. We have so many deals that's happening in fintech. We have so many deals that's there in health tech, right? But on the other hand, we have seen that ed tech has flattened now. Education technology flattened, right? There's already consolidation that has happened out there, right? Now we are talking about space tech, space technology. So there's so much of action happening around space technology. So that's a booming sector for the time being in case of startups here. So what is the size of the market? What's the growth stage in the market? Right? Macro trends and timing. Once again, everything could be okay, but your timing the market may not be okay. And you may be too late into the market. You will not get a premium for that. Measure of consumer intent, right? What is the consumer wanting from the customer, from the startups? That is another measure that will help you. I spoke about business, right? So look at the product. Again, the scalability and the competitiveness of the product. The business model, is it going to be recurring revenue or is it going to be one-time revenue? If two companies are offering almost the same product, one is a B2B company and second is a B2C company, the B2C company is likely to do better than B2B company because it will have less concentration of customers and it will have bigger scalability, normally speaking, right? So is it recurring revenue? Is it shorter sales cycle? Does it have large value proposition? That's all of those are going to be crucial to get a higher valuation. Look at the traction, right? So when traction is again the recurringness, right? So is the market accepting your product, right? Are your sales increasing? Are your customers engaged with you, or they are just taking your product and forgetting about it, right? Are you getting repeat customers, customer retention or customer repetition? All of that is going to be important from a business standpoint. Then you have financials. So burn and use of funds, positive contribution, right? Everyone knows what is contribution, right? It's sales minus the variable cost. So are you selling, are you making some money on every product that you are selling? You may have fixed cost that will be recovered in the longer period of time. But at least on a variable cost basis, you should be able to recover variable cost, right? What are the previous rounds of funds? What's the past valuation like? How much of dilution would you expect? And then of course the team, which is either it's a new team or an experienced team. Does it have enough potential? Do you have the tech team? Are the co-founders working full-time or they are part-time workers? All of these factors must be assessed before you get down to valuing any startup. Okay, so when we talk about this, let's move into the core aspects of valuation, which is the three approaches to valuation. Okay, the first approach to valuation, I'm sure you're familiar with this, is the cost approach. The cost approach is the very basic approach of valuation, where we say that we will use the net asset value or the balance sheet approach, right? We also call it the asset based approach. It is the asset based approach, and we start with the balance sheet. Okay, you start with the balance sheet. So when do you apply the cost approach? Where the income approach or the market approach cannot be used, where an asset can be quickly recreated with substantially the same utility as the asset to be revalued, right? So I have created a technology, but it's not a great technology. Somebody can recreate that technology without significant efforts, right? Then no premium would be given to me. Third, when liquidation value is to be determined. So again, we will talk about companies. We've been talking about companies which are distressed. So when the companies are into distress, you would apply the cost approach. Also, the valuation standards say that the cost approach can be used along with other approaches. When an asset hasn't started generating income. When the asset of substantially the same utility as the asset to be valued can be created, but there are regulatory or legal hurdles. I have created a technology and now I have patented it, and nobody else can use the same technology to create again. So now I have, it can be recreated, but there will be some regulatory or legal hurdles, right? So in that case, I should get some premium. So I will say I have valued the company using the cost approach, but because there is a premium that I can assign, I will use cost approach plus one more approach, and then maybe I can assign weights to that. Third, when the asset was recently created. Now see, if the asset is already at the end of its useful life, you will apply liquidation approach. But if it was recently created, you will say the cost approach, but you might also want to apply another approach saying that, hey, the cost approach does not capture the future potential of the company, right? So if it's recently created, maybe I will apply the cost approach as well as the market approach, or cost approach plus the income approach, right? So the cost approach can be used along with other approaches like this. When do you apply the income approach? Where the asset does not have any market comparable or comparable transactions. So cost approach can be applied when income and market cannot be applied. Income approach can be applied when the market approach cannot be applied. Where the asset has fewer relevant market comparables, or where the asset is an income producing asset for which the future cash flows are available and can reasonably be projected. Now, see, to apply the income approach, you will need income projections. The future cash flows are available and are reasonable, right? So, in case of startups, this is the difficult angle, right? Because the future cash flows cannot be reasonably projected. How do you know the future of startups? How do you know how the company is going to fare? It has got limited history, right? The management is new. You don't know whether the market is going to like the product or not. So in those cases, the income approach is very difficult to apply in case of startups. Then it says that when the income producing ability of an asset is the critical element affecting the value from a participant perspective, the income producing ability of the asset is critical. Now think about it, right? Let's say um, let's say you have to value a building or an office space. I'm talking beyond a company for the time being, right? I'm talking about let's say a building, and that building is giving you some rent, and that rent is only 2% of the building value, right? Only 2% of the building value. Now regulations say that a building useful life is considered to be, let's say, about 50 years or 60 years. So whatever the value of the building is today, right, the rent, if you apply the income approach, what are you going to do? You will take the rental income and you will discount it. Now you cannot simply take the rental income and discount it, because you will also need to consider the occupancy rate. The building may not be utilized for the entire 60 years of its life. It may not be rented out. There will be some occupancy rates. I mean, it will be occupied for some time, it will not be occupied for some time. There's going to be expenses towards wear and tear. Every 10-15 years you will have to spend significant money to restate that building, right? And all of that. And despite all the efforts, the present value of the rental yield may be much lower, much lower than the current market value of the building, right? So the income producing ability of the asset, which is the rental income from a building, may not be the critical element which is affecting the value from a market participant perspective, right? Because somebody, you might not be using that building only for rental purposes. Somebody could be operating a business from that building, and there the value that the building is going to reap is going to be far more than just the rental income. So similarly, what I'm trying to say here is that apply income approach when it is relevant. Do not apply income approach just because we can create Excel spreadsheet, we can create financial projections in an Excel spreadsheet, right? It's very important to understand that. So income approach should also be considered along with other approaches when the timing and the amount of future income is uncertain. Again, they are referring to startups. Think about it. You have a startup, right? You're working on an idea, but you don't know when it is going to start generating revenue. 2 years from now, 1 year from now, 3 years from now, we don't know. Second, when there is lack of access to information, if you do not have information, you cannot apply income approach. Very important. And third, Now it is saying that you can apply an income approach to startup. It says it has not yet begun generating income, but is projected. Projected. What's the difference between projected and hoped? Hope is I think it will generate sometime. Projected, I have reasonable projections. I know it should be able to do it very soon. Right? There's a difference, right? So think about it. It says that cost approach, you are saying that the asset was recently created, use along with other approaches. Hasn't started generating income, use along with other approaches. Income approach says not yet begun generating income, but is projected to do so, right? And future cash flows can be reasonably projected. In those cases, you apply income approach. So what we do in case of startups is we apply the income approach and the cost approach. And this is very similar to what I said earlier, that you can apply the probability, right? So value as per going concern, you will apply income approach, and value of default, you will apply the cost approach. Take the weights of these and you will be okay. All right. Once again, taking a quick pause. If there are any questions at this point, is the speed okay? Are you understanding what I'm saying?
Yes, sir. There are a couple of questions.
Yes, let's hear them.
Yeah. So huge salary of founder in previous job of which he may be the master cannot be taken as a reference for salary in startup if the fields of job and startup don't match. Can it? What is the way to calculate opportunity cost then?
Fair point, right? So if I was working in a textile company as a CEO and now I am starting a technology company as a founder, right? I may be an absolute naive person from a technology standpoint. And therefore, if I'm not taking salaries, it's fair point. Okay. But think about it. I should be getting something, right? I'm going to put in my sweat and blood into the company. So therefore, some compensation should be assigned to me, right? Now that compensation, there are various ways of assigning that compensation. You could give me a salary of a manager in a technology company, or you can give me a salary of a manager in a textile company, but there is a resource which the company is utilizing, so that resource should be accounted for. So if you are saying that I was a senior employee in a technology company and now I'm starting a technology startup, you can assign the same salary to me, right? That I was deriving in my previous company. That could be a proxy. You could say what would be the salary of a manager in the technology company, right? And I'm working like a manager, not a technical manager, but at least a behavioral manager. At least I'm managing people, right? At least I'm doing some sales. So you can give me some salary like a salesperson or an HR person or a general manager in general, and assign some salary, notional salary to me in terms of profit and loss, right? In terms of your salary expense to the company. I hope that answers the question. Can we go to the next question, ma'am?
Yes, yes. So the next question is, how much is the weightage of quantitative and qualitative approach involved in valuation of startup in general?
Okay, so there is no statistic behind it, but if you ask me, I would say around 70% to 80% of it is qualitative. Only about 20% is numbers. In fact, if you put yourself in the shoes of an investor, right, and we talk to hundreds of investors, right, we work with, I mean, we valued about 600 plus startups so far, right? So when you talk to investors, the investors do not go into a discounted cash flow approach kind of a thing, right? They will say, oh, okay, let's look at your idea. They will look at the idea and say how good the idea is. They will understand what kind of sector are you in. So whether that sector is a hot sector or not. Again, we are talking about the market, right? If you imagine, I mean, we are almost 1 hour into the conversation. I think more than 1 hour into the conversation, almost an hour into the conversation, but we are only talking qualitative factors, right? Only qualitative factors. So 70 to 80% is qualitative. Only 20% would be numbers. And when we discuss some of those valuation approaches in today's session, you will realize that some of those cases are very simple. I mean, very simple. I mean, there's hardly any numerical application there, because remember I said that we are going to price the startups, we can hardly value the startups. So 70 to 80% qualitative, 20 to 30% numericals, objective.
The next question is, if we are doing valuation for acquisition in certain industry where such acquisition has not happened before, is there any trick of arriving at exit multiple?
No, so you would be the one who's going to be defining the exit multiple for the rest of the market, right? So uh, see again. So let's look at it this way. How do acquisitions happen, right? So let's say if I have to value a company, and if I have to value a company for an acquisition, what's the difference? I can still value a company at fair value based on all the approaches that we've been talking about, the cost approach, the income approach, etc. You might say that arguably, since there are no precedents behind it, I cannot apply a market approach. Fair point. Don't apply a market approach, right? We have been discussing how, and we haven't even gone to market approach so far, right? We are still talking about cost and income approach. So you value the company out of on a fair value basis, right? As any other market participant would, and then apply a control premium. That's about it. Now, control premiums would depend on various factors, right? And typically, there are multiple studies which have been done where they say that the control premium should be in the range of 20 to 30%. So, fair value plus a control premium would give you an acquisition value, right? And that's the value from where you start your negotiation. There is no guarantee that that is the number at which the acquisition would happen. But fair value plus about 20-30% is a thumb rule that we usually take when we do not have any precedent at all, and then we leave it between for the negotiators to negotiate and arrive at a value. Again, I hope that the answers have been the questions have been answered. When we take the next question break, if there are any follow-up questions, I'm happy to take that on these as well, plus new questions if any.
So we can continue with the session and
Okay,
take
super.
questions in the next break.
Yes, thank you so much, ma'am. Thank you. I think this is going okay for me, and I hope it's going okay for the others as well. Thank you. So we've talked about this, right? Now, and you see, we're not discussing too many market approaches here, right? In case of startups, we implicitly assume that, see, unless there is a transaction multiple, which I'm sure every professional here understands, we don't have to worry too much about market multiples here. Now, let's talk about some few points, especially which are relevant for startups. So there are more than 100 unicorns in India. Now, what is a unicorn? A unicorn is a company which has a market value of more than $1 billion. And it's like a buzzword, right? There are so many people who are talking about unicorns. But hey, hold on. It is a perceived value. Think about it. You start your own company today, okay? And you reach out to your uncle, your maternal uncle, and you say, sir, uncle, can you give me 1 crore rupees? Right? And against that 1 crore rupees, because he's your uncle, he says, okay, I don't mind, give me 0.1%. Now, what is the implicit value of your company now? 0.1%, right? Against 1 crore. So if it is 1 crore, and for which you are getting 0.1%, right? What's the value of your company? 1,000 crores, right? Yes or no? Now that's an implicit value of your company. You have raised only 1 crore. Remember, you have raised only 1 crore. So it's just an eyewash, right? I mean, of course, I'm not saying that that's how companies become unicorn. No, that's definitely not the case. And I have a lot of respect for companies who reach that stage, because this is just to help you understand how implicit valuations can be, right? But the ones who are unicorn, they are very, very large businesses, and they have done a lot of they have shed a lot of sweat and blood and things like that. So I'm not saying that they are not meaningful at all, but those valuations can still fluctuate, right? So let's stop giving too much value to a unicorn, because understand, unicorn at the end of the day is a mythical creature, right? It doesn't exist in reality, and therefore those valuations of companies also may not exist in reality. Okay. Also understand that most startups are loss making. And this is very interesting and very important, right? That investors have very shorter time frame now. So earlier, an investor would take, for example, a venture capitalist or a private equity firm would have an 8 to 10 year time frame. Now that time frame is going down to 3-4 years at the max. At least they want to cash out as soon as possible. At least they want to cash out on their principal portion as soon as possible, right? Also remember that IPO is an exit route, but it puts larger people's money at stake. I mean, I'm sure you have read stories, depending on, irrespective of whichever part of the world you are, right? You have read stories of companies like Paytm. Now, what happened in case of Paytm? In case of Paytm, the investors, the company, before the company went for an IPO, there were so many investors who were there, right? Now, when the IPO came, it was an offer for sale for a very large part. So these investors sold their money, sold their stake through an IPO and made tons of money for themselves. But at the same time, who bought those shares? Those shares were bought by subsequent investors, public market investors, retail individuals, right? And they could not derive the same value that these investors did. But having said that, a lot of water has flown under the bridge since then. Companies have matured, the ecosystem has matured, and now we don't see that kind of valuations during IPO. Even the regulators have been extremely active in India for when it comes to protecting people's money. So there is a lot of regulation now. There's a lot of questions that people raise now, but at the end of the day, an IPO will put larger people's money at stake. Whenever there's an IPO, we must see whether we are talking about an offer for sale or issuance of fresh equity shares. When there's an offer for sale, means that the company is not getting new money, right? It is only the existing investors who are cashing out. So personally, as an individual, I am not in favor, or I'm not a big fan of companies who go for an IPO with 100% offer for sale, because the company is not creating value for me, at least, right? I mean, it is going to use the same money that it had. It is only giving the existing investors an exit. But if there is a reasonable amount of money that the company is raising through fresh equity, and there can still be a part of offer for sale, that's all right. So there, I know that some money is going into the company. The company is going to use that money for expansion, right? There is going to be an expansion of operations, etc. So that's just one of the things that I look at when I'm evaluating companies when they go for startups, when they go for IPOs. Now, also understand that a large number of entrepreneurs drop off after raising funds. So there is a huge percentage of people who raise funds once and then they never come back again. There's a good number of people, right? And again, these things, I mean, we these things are getting corrected as we go along, as the ecosystem has matured, right? But we all understand that there are a lot of people who come into the startup space because they think that there is easy money flowing in. But trust me, last 12 months at least, we have seen in India also, and of course the rest of the world, that there has been a funding winter which continues to be there and it has been around for a very long time. So entrepreneurs, now there's far more due diligence that's happening now, and as valuers we also need to do it, right? So as valuers, we are being very cautious of understanding whether the management is serious about this fundraise, is serious about the business, or are they serious entrepreneurs who are running 5 different startups at the same time, right? Then increase focus on profits and positive cash flows now. Okay, this is very important. As the ecosystem has matured, we have seen an increased focus on profits and positive cash flows. There was a time when companies never cared about profits. I mean, the investors never cared about profits. They said, we want customer traction, we want revenue growth, profit I and I don't care whether profit comes or not, right? But now that's changing. Investors are asking for profits, investors are asking for positive contribution, investors are looking out for EBITDA. The payback period is very important now, right? The break-even points are very important now. Those were not questioned earlier, right? So those are some of the interesting things that we are seeing in the startup space. Let's talk about the first valuation method, which is specific to startups, right? And it's called the venture capital method of valuation. Anybody who's familiar with valuation for startups understands this. Now, see, this is what, and this is also going to reinforce the question that we had, that how much of valuation is subjective and how much of it is objective in case of startups. Right? So think about it. If I am an investor and a startup comes to me and says that Vikash, I'm a new company and we are looking for funds. So if you're a new company, there are so many things that will happen for which you have no visibility today, right? Whether the customers will accept it, whether the competition will catch up, how many people or how many new players will get into the business, right? Whether you will be able to innovate enough, the customer preferences will change, whether you will be able to scale geographically or not. Are you going to be a local player or a global player, right? There are innumerable questions out there. So now any investor, and especially when we're talking about venture capitalists and private equity investors, they have if a horizon of 5+ years, right? They would normally have horizons of 5+ years. They say, I'm going to put in money today, but I'm not expected to leave you before 5 years. And I'm doing that because I know that for the next 5 years, there's going to be a lot of turbulence, right? I mean, there's going to be a lot of ups and downs. So forget about what are you going to do in the next 5 years. Tell me, where do you expect to see yourself in 5 years? Okay. That's what the venture capitalist asks the founders, the startups. Where do you see yourself in 5 years from now? Now, that's an interview question that used to happen. It's the same question that's happening in a startup pitch as well. Where do you see yourself 5 years from now? The company says, I am looking at a profit, right? We may not be positive today, but I'm looking at a profit of 20 crores, 20 CR after 5 years. It says, all right, 20 crores is what you're looking at. Super. I'm going to look at a PE multiple. So your industry is new today, but 5 years from now, it is going to mature, right? So are you in healthcare? Are you in technology? Are you in education? Are you in hospitality? What sector are you in? So I'm going to look at the PE multiple of that sector. Let's say the PE multiple of that sector is 20. So what is the value that I'm looking at 5 years from now? I'm looking at a valuation of 400 crores, correct? That's the valuation I'm looking at. And now I am looking at it. I'm looking at a 30% return. Okay. I'm looking at a 30% return. Now I can't do this part of the math without a calculator. But what I'm going to do is I will say 400 crore, PV of 400 crore at the rate of 30% for 5 years, right? That's my value of the company today. That's it. Now see, we are not talking about your revenues. We are not talking about your EBITDA. We are not talking about yearly fluctuations. We are not talking about success, non-success. Nothing. Absolutely nothing. We are saying, where do you see yourself 5 years from now? And that's how venture capitalists actually put in money. A lot of them. They do a lot of the scorecards that we've discussed so far, but that's how they arrive at the valuation number. Okay. And here's the literature for you. Estimate the expected earnings or revenues in the future. It could be earnings, it could be revenue, it could be EBITDA, whatever, right? Multiply the earnings in the future by the multiples of earnings, EBITDA, revenue, whatever. So for example, equity value at the end of the forecast horizon, we are talking about 5 years, right? Is equal to expected earnings in the year end, that is profit at the end of the 5th year, which is 20 in our case, right? Multiplied by forecasted PE, which is again 20 in our case. So the estimated value is discounted back at the target rate of return. In our case, this is 30%, right? So this is 20. This is also 20, right? And this is target rate of return. This is 30%. Okay. So this is also called the pre-money value of the firm today. This is the value today, right? So this is the venture capitalists or the investors will say, hey, this is the value of the company. The new capital brought in by the venture capitalists is added to the estimated value to arrive the post value. So whatever the pre-value is, pre-money value, plus whatever money the investor is going to give you. So if the investor is going to give you 1 crore, you will add 1 crore here. If this value came at 7 crore, so you will say 7 crore plus 1 crore is the post-money valuation, which is 7 plus 1, 8 crore. Today, the value is, let's say, I don't know what the math is here, but this is going to be 7 crore. Okay. So I'll give you an example to help you understand this better. Very simple. So let's say a young edtech company is expected to go public in 10 years from now. The valuer expects that the net profits of the company 10 years from now would be 95 crores, right? So this is the net profits. Expected profit 10 years from now is 95 crore, right? And of course, how do you arrive at 95 crore? The founder will do their math. No problem. They will have some expectation. They will have some revenue. They will have some projections. Yes, that's definitely there. I'm not saying that the numbers do not matter at all, but I'm saying for the valuation point of view, it will not be as important, right? So average PE multiple of publicly traded edtech companies is 20. So the company is evaluating fundraising from the investors who are expecting 45% from the investment until the company goes public. That is, their investment horizon is 10 years. So exit value would be 95 crores into PE of 20, that is 1900 crores. You divide it, you discount it at the rate of 45% for 10 years, you get 46.25 crores of valuation today, right? That's how you can apply the venture capital method of valuation. I have to take a pause. I want to understand if you've understood this. Are there questions? There are other methods, but ma'am, I hope you don't mind that. I'm sorry I'm troubling you with this, but if there are questions in this method, we can take it up now.
Yes, so there are questions. So There's one question. What can be employed to minimize subjective bias when assessing the valuation of a startup by making slight adjustments in discount rates or premium or in multiples of comparable companies?
So again, I discussed this, right? So one is and that's the problem that we see, right? That when the valuers are valuing the company, they take a discount rate, or and even while calculating the discount rate, there are, for example, we have an unsystematic risk premium, or we are taking any multiples, right? So those multiples are often subjective, and it should not be subjective. So so first of all, okay, there will always be an element of subjectivity in valuation. If there is no element of subjectivity, you can have a software which is doing the entire valuation, and there's no need for a valuer. If the entire valuation exercise is 100% objective, you don't need people for that, right? And it cannot be and should not be 100% objective. There will be element of subjectivity. How do you reduce the biasness while exercising that subjectivity? We discussed about the scorecards, right? We spoke about all of this. So you can have your internal scorecard where you say, okay, these are the parameters. We have discussed a lot of them. We've talked about market, we've talked about teams, we've talked about business. Have your scorecard in place. Based on your scorecard, you can derive a rate yourself, right? That, okay, I am going to assign weightages to these parameters. I will give them scoring, and based on that, I will have my own discount rate or multiples. Correct? And that is exactly how you can reduce subjectivity. If you don't have something like this, you will put a random number, which you will not be able to explain. Right? Next question, ma'am.
Thank you so much, sir. So the next question is, if it's mostly qualitative, then how, as a professional, do we justify our work in final report and professional fees?
Once again, so the answer goes back in the time that we've spent about an hour talking about how do you identify those parameters, right? So once again, when I'm talking about that, hey, you should look at the market, you should look at the business model, you should look at the team, you should look at the scalability, you need to document that, right? If not in the report, at least in your own calculations, right? Because otherwise it is going to become a templatized valuation for which you will not get fees. And there are people who don't get fees because they do a templatized valuation, right? So you need to be able to document these parameters in your own records, and that is how you will be able to command a premium.
Thank you so much. So the next question is, professional liability of auditors, valuers in separating scam and startup, legal liability and fines, if any, involved.
So I'm not aware of any specific professional liability in valuing startups, right? But there are of course legal requirements where a valuer is required to be diligent, and the valuer should be exercising judicious approaches while doing the valuation, right? The penalties could be anywhere, which may be to the extent of the fees that you've received, to suspension for 6 months, to, I mean, there can be some provisions which could involve very exorbitant penalties as well. And of course, those differ from industry, from country to country. But yes, it's a role which does give you a lot of responsibility, because your numbers are the ones based on which somebody would be putting in their money, right? So yes, it depends from regulation to regulation. For example, in India, Section 247 is the charging section for valuers, where they say that where they talk about penalties for valuers.
Thank you so much, sir. That's it. We only have this much questions as of now.
Okay, thank you, ma'am. Right, we move to the next method, right? So there are some other methods which are again specific to valuation of startups. For example, there is one which is called the Burkus method. Now, we don't apply the Burkus method in India, but we definitely refer to it from a learning standpoint. So Burkus method says that you can assign a maximum of 2.5 million, right, to a startup. Now the problem is, this is dollars. This is 2.5 million US dollars, right? So it says give them a rating. So have your own scorecard once again, right? Give them a score, assign a score to it, and based on the score, if the idea is very sound, you can give them a value of up to 0.5 million. If the company has created a prototype and therefore it is reducing technology risk, right, then give them another 0.5 million. So move to the next bucket. Now again, it is not saying that you will give them 0.5. So here, let's say it earns 0.1 million. Okay, here again it says 0.5 0.5 million. It's possible, correct? Quality management team reducing execution risk. So again, give them a scorecard. So if the team is, if the management team is highly qualitative, they have a appropriate experience, there are no cases against them, there are no complaints against them, they are diligent, they are respectable, they are reputed, right? And you will have interactions with them, isn't it? So you will realize that, okay, this is a serious team, this is not a serious team. This, so again, you give them a scoring based on that. And therefore, let's say you again say this is 0.2 million, right? So you give them a score based on that, you give them a maximum of 0.5. Okay, strategic relationships. So is the company having good client base? What kind of is the company having brand enough? Is the company attracting good resources? Is the company able to attract good people? Right? What kind of strategic relationships? Do they have contracts signed with the customers, etc.? Right? All of this comes under here. So do they have strategic relationships? So let's say here again it says 0.05 million. Okay, and then you have product rollout. Has the product been rolled out? Is it already generating some revenue? Yes, to what extent, right? So you again assign some weightages here, and you ultimately arrive at a final value which is less than equal to 2.5 million, but is a way to value startups. Now, this is, of course, these numbers are based out of US, but nobody stops you from applying the same parameters, right? And change the benchmark to say, hey, instead of 0.5 million, I'm going to give 50 crore rupees, right? Whatever, right? You can assign whatever value you want. The idea is that are your valuation methods standardized internally, right? That's very important. Okay, how much object, so that objectivity needs to come in the process, not in the numbers across companies, right? The other method is called the first Chicago method. It is an extension of the previous method, an extension of a DCF method or a venture capital method. So the first, now see what happens is the first Chicago method says that let's do the projection of future cash flows. So you've done that. You also do a terminal value projections. You've done that, right? You discount back the cash flows and the terminal value, yes, and you calculate the present value, yes. Now you've done all of this, right? This is a simple application of the DCF approach. What the first Chicago method says is you take three cases, scenarios. That's where the first Chicago method is different. Take scenarios. Take the base case. Okay. Take the bear case and take the bull case. Meaning, take the base case, take the pessimistic approach, take the optimistic approach. Do the valuation 3 times. And after doing the valuation 3 times, you assign weightages to that. Scenario A, scenario B, scenario C, base, bear, bull. 3 values, assign weightages to them, and you get a final value, which is the first Chicago method. Once again, there will be element of subjectivity, but you would have documented a possibility of failure. You would have documented that the company can do better than what it is saying. It is also possible that the company is giving you a forecast which you think is too optimistic. So you take the company's forecast as bull case, right? And then have the 2 layers down, saying that, okay, bull case, it is going to go at 100% revenue growth. Base case, it is going to grow at 10%, 15% revenue growth. And bear case, it will have no revenue growth at all. Possible, correct? So take the 3 scenarios, arrive at the valuation, follow the 4 steps above, and you get the final value. Okay. So those are 3 common methods that we apply in case of startups: the venture capital method, the Berkus method, and the first Chicago method. Okay. Now, I always believe that methods are just means to reach an end objective. Okay. Every startup is unique. Every business is unique. While we may have these methods, we should be able to assess the company on its own merit. Okay. Let's take an example of that. I have to value a company like Flipkart. Now, again, I'm not saying it's Flipkart in today's time. Okay. But I have to value a company like Flipkart. It's going to be a huge exercise, no doubt about it. A very, very large exercise. But put yourself in the shoes of a billionaire, right? A person who's going to put in a lot of money. Will the billionaire really go for a very detailed financial model and all of that? They will look at those models purely from a compliance standpoint, right? How can you value a company like Flipkart? And this is just for academic purposes. I would not value Flipkart like this if they give me an engagement to do it. Let's face it, I will not. But from a conceptual standpoint, right? How can you value company using operating value drivers? Let's see. So I will say that, hey, I do not have a company as big as Flipkart in India, but there is a global competitor, which is Amazon. So I will look at Amazon's market capitalization. It's a US listed company, right? And there are valuation literatures which says that if you don't get a comparable in the same geography, keep expanding the market. You will get a global competitor. You will get a global peer. You will get somebody who's in related business, not exactly the same business. Okay. You and your brother are not the same people. You and your sister are not the same people. Try to realize that. So there's nobody who's going to be unique, but they are the ones who are going to be closest to you, right? If somebody has to understand you. So look at Amazon's market capitalization. Let's say there's going to be the value driver. So value driver could be users. It could be order value, right? It could also be average order value. I'm taking one value driver as an example. Okay. One example is user. The second could be average order value. It could be something else as well. We're just taking an example. So what you do is the value driver is the value per user. Okay. Which is market capitalization by number of users. Can you get both of this information? Yes. It is a listed company. You go to the company's website, you go to the company's financial reports, and you will find number of users somewhere, right? Average number of users throughout the year or average order value throughout the year, correct? And you have a market capitalization. So you get the value driver. Now, when you have to value Flipkart, you say number of users of Flipkart, okay, multiplied by the industry or peer value per user, right? You get the peer value per user. What is this Flipkart's value? Now, again, this is a starting point for you. This cannot be Flipkart's value. Let me tell you that. It cannot be Flipkart's value. But this is a starting point. Now you look at the company for different factors. You will say, hey, Flipkart is an unlisted company. Amazon is a listed company, right? I will have to make some adjustments for marketability. I'll do that. Second, Flipkart grows in the US, in fact, in multiple countries, right? Others. Flipkart has got growth in other countries. Sorry, Amazon has growth in other countries, but Flipkart is growing only in India. Okay, that is global presence. Then you have product diversification. Amazon's value is also derived by some of the other businesses that Amazon has. For example, Amazon Prime that Flipkart doesn't have. So do you split that value at all? Then there can be currency differences, right? So you make differences for these, but can you still do a simplified valuation of Flipkart? Arguably, yes. Of course, don't do this for financial reporting purposes or valuation reporting purposes. But once you've done the valuation of Flipkart using, let's say, a DCF method, which is going to be fairly complicated, can you do a double check for yourself using an approach like this? Possibly yes, right? How do you know that the value that you're getting using the DCF is appropriate? You can have another method using value drivers to calculate that. Let's take one more example. I want to talk about one more example. Okay. And for the record, earlier, e-commerce companies were valued using the GMV, the gross merchandise value multiple earlier, right? So the third value driver used to be the gross merchandise value, which is similar to the average order value. Let's talk about another company, right? And here we will bring in some subjectivity. So let's say we are in the year 2014, and we are talking about a company which has come to us for valuation. And this company is called Chat App. We've given it a name, Chat App. Okay. And this company has 1.6 million users, and the company does not report any revenues at all. Okay. So once again, I'm giving you 3 data points. We are in the year 2014 or around 2014. There is an app called Chat App, and it has got 1.6 million users, and the company does not report any revenue. Okay. How are you going to value this company? And we will take 2-3 scenarios of valuing this company. Okay. So 2014, how are you going to value Chat App? Now, in the absence of any number, right, any financial number, how do you assign a value? You might want to ask the company and say that, hey, okay, you're not generating any revenue, but you must have incurred some expenses, right? How much money have you spent in acquiring these 1.6 million users? And how much money have you spent on building this app? At least that can be my starting point. Let's say you're an outsider and you don't have that information either. What can you do? Let's see, right? I say that, hey, I know of a company which is in the similar business, right? Text messaging app. And I have a transaction multiple, comparable transactions method. I have a transaction multiple. So I know that this company, a competitor, was acquired for $19 billion. We are saying US dollars. Again, let's take it as a simplistic example, 19 billion, 17 billion, we'll come to that. $19 billion. The daily active users of WhatsApp at the time of acquisition is 450 million users. So what's the value per daily active user? 19 billion divided by 450 million gives you $42.2 per user. Okay, that's the value per user. Now, this is a very arguable number, right? Because see, no user is paying to use WhatsApp, but WhatsApp has sold the company at a valuation of $42 per user. Okay, so now, but this is in US dollar. We are sitting in India, right? So I have to value this company in India. So let's say my exchange rate is 70. It's different now. I'm saying hypothetically 70. So you multiply 42 into 70, you get 2955.56 INR. That is value per user. Now I need to pause here, right? It's very important to understand that, hey, can I take this 2955.56 and multiply with 1.6 million to get to the value of the company? I can't. The reason is there is a huge difference between 450 million users and 1.6 million users, right? There's a huge difference, very, very large difference. So while I'm saying that 1.6 million users is something, it's not nothing. Imagine we are talking about 16 lakh users, which is a good number. But this good number is nothing in front of 450 million users. Then today, that number of users is 1.3 billion. 1.3 billion WhatsApp users are there in this world, more than 1.3 billion users. That's the entire Indian population. 14% of the world's population is using WhatsApp today. That's a big feat. Okay. So now I cannot apply this multiple straight away. So what I do is I have multiple options now. First of all, I will say, hey, this 19 billion is actually not 19 billion because 15 billion was only the goodwill, right? But hey, the company got goodwill, right? So we can always argue on that are you going to value the company or are you going to include goodwill or not when you're looking at this multiple? So we normally include goodwill. So 19 billion remains intact. Okay. But I'm going to say, what is 1.6 million as a percentage of 450 million? Now, see, I can create a model where my company value will increase as the company keeps on acquiring more and more users. So I'm going to say that if I take 1.6 divided by 450, what do I get? I get 0 point something, right? 0.34 or something like that. So I'm going to say that I will take that as an adjustment. Okay. I will take that as an adjustment. So I'll say 99.64 discount to 2955. What do I do is I give them and I assign a value of 10.51 rupees per user. Now see, when I'm doing this, I have removed entire subjectivity from this valuation, right? The only subjectivity I have is my benchmark itself, which is WhatsApp. Everything is fully calculated. Okay. And I'm saying that you get value 10.51 rupees per user. You multiply this with 1.6 million, that is 16 lakh users, you get a valuation of 1.68 crore. Done. Right. And if you really see how much money would the company have spent on developing the app and getting 1.6 million users? Just about this. Just about this. Okay. But I have a question. What if this was 1600 users instead of 1.6 million users? Would I give them any value? Would I even compare it with WhatsApp? I would not. Why? Because I would take about 5 to 7 lakh rupees to develop an app. And acquiring 1600 users does not take effort. You go to a college, you go to an educational institute, right? And you say that, hey, I'm going to give you 20 rupees of talk time or whatever, right? If you install this app. And that's all you have, right? Installation of the app. So acquiring 1600 users will not give you any premium at all, right? You would simply apply the cost approach. Here I had a situation where the company had 1.6 million users and I had no Indian comparable company. Therefore, I used a foreign comparable company and I arrived at this value. And this is a little more than what the company would have spent so far. So I'm giving them some premium. Now imagine I have created a model. So now the moment it is 5 million users, right? Even if I apply the same approach, this percentage discount will go down and this value will go up, right? I might be doing the same thing. I have created a fluidic valuation model. It can go on like this. Okay, let me take a pause again, and we've got 30 more minutes to go. Let's see if there are any questions. We have discussed some numbers. We have discussed 3 valuation methods. We have taken a couple of examples. Let's see if you have any questions so far.
So there are no more questions as of now. However, it was scheduled to be for 5 till 8.
Oh, we don't have much time then. Okay, sorry. I thought that this is okay. So can I have I can wrap up in 3-4 minutes then?
Yes, sir, definitely.
Yeah, 3-4 minutes. I'll take about maximum 5 minutes and I'll wrap it up. Okay, so we will not be able to go into distressed company valuation for sure, right? But let's wrap this up in 5 minutes. In fact, yeah, that's practically the last slide. Okay, so when we have, how do you value these companies using DCF method? So if you have a company like this, right, what we do is you have the revenues, you have the PAT, you have the depreciation and non-cash expenses and all of that, right? You estimate it for every year. You arrive at the free cash flow, and I'm sure free cash flow has been covered. Ma'am, can you confirm that to me?
Sir, I'm
Valuation
sure.
of equity is covered, right?
Yes,
Or
yes.
a DCF method would be covered. So if that's
Yes,
covered,
it's
then the
covered.
participants would be knowing that, right? So you estimate it for each year. You get the free cash flow. Now, some of the things that happens in case of startups is you have the value of the firm using DCF. You make adjustments for debt. And you get the value of and cash. You get the value of equity. Now, what here they do is there is a discount for key managerial people. Now, in case the company is getting acquired and you know that the director will resign after the takeover, then you make a discount for key managerial people. Okay. In case there are any investment property, you add that because the DCF does not capture the investment property. You get the value of equity. You divide it by the number of shares, you get the value per share. Okay. A couple of things that people tend to make a lot of mistakes around while valuing companies under the DCF method and for startups is that they arrive at this value and then they apply a DLOM, a discount for lack of marketability. Please remember that discount for lack of marketability should always be included here when we are calculating the discount rate here, right? Discount for lack of marketability is applied separately when we are applying the market multiple. But whenever we are using the DCF, we do not apply discount for lack of marketability after calculating the value of equity. It's always before that. Okay, so that's about it. In fact, thank you very much. Right, I'm glad that at least I was able to cover the entire startup valuation piece. Right, that's about it from my side. That's my contact in case you have any inquiries, and that's the book that I've written in case somebody wants to refer to it. And that's it. Thank you very much.
Thank you so much, sir. It was a great, insightful session. And thank you for sharing your learning and your expertise with us. So, this marks the conclusion of a 5-day journey of online comprehensive course on valuation and valuation standards for members of Institute of Chartered Accountants of Nepal. Dear participants, as we conclude, we extend a sincere thanks to all our distinguished speakers for their valuable insight. It indeed has been an enriching journey through valuation expertise. We also express our gratitude to the chairperson of Valuation Standard Board, ICAI, CA Hansraj Chuk sir, and vice chairperson of the board, CA Preeti Paras Savla ma'am, and the entire support team of ICAI for initiating and supporting this program and guiding us through the journey of 5 days. We would like to acknowledge and appreciate our audience for dedicating your valuable time and for your active participation. I request you all to fill the feedback form. Your feedback helps us improve. A good event never ends. It only takes a pause and keeps us waiting for the next. So until we meet next, please stay informed and remain committed to your pursuit of excellence in the field of valuation. Have a wonderful evening. Thank you, everyone.
Thank you very much, ma'am. Thank you. Take care. Thank you for all the audiences and the ICAI support team for organizing this. Pleasure. Thank you.
Thank you.